Good day, ladies and gentlemen. This is David Marsh. I'm the chairman of OMFIF, and I'm very pleased to be introducing a session going on for around 3 hours with the Nederlandsche Bank and ourselves on developing European capital markets. We had originally intended to hold this seminar live and in person in Amsterdam in March. It had to be postponed because of the COVID crisis, and now, of course, we're on the front of a new downturn, a new lockdown, but I'm very pleased that we're nonetheless able to gather together quite a few friends and colleagues from all over Europe to talk about this vitally important subject. Of course, it is still a great blight on us that we have the COVID crisis continuing, and I'm very much hoping that this seminar, which is totally on the record and open to everybody, will present some answers to questions which are really burning questions for European development. It's so important to have good capital markets functioning in Europe. Ludwig Erhard might have said capital markets are not everything, but without capital markets, everything is nothing. And it is important to get these capital markets going to promote European recovery. We have, of course, had a distressing and rather difficult time in Europe and indeed around the world in the last 6 months. And I'm afraid to say the shadows have not lifted. Our hearts go out to everybody in Vienna afflicted by this latest tragedy that we had unfortunately yesterday evening. And I believe the wave of terror there is still continuing, and there's still a lot of doubt about who carried out these atrocities and how they can be brought to justice. So our great sympathies to all of you who may be in Austria. I know Thomas Wiese is on the line, for example. There has been some solidarity in Europe though, and this is a good part of the crisis, I would say. People have become more used to looking at what is going on across boundaries in terms of the depressing statistics of the disease, but maybe more upliftingly, we have seen a lot of solidarity at the European Union level in July with the Recovery Fund, which I think has been a major achievement. And then the European Central Bank has done what it needs to do so far. We mustn't rely too much on central bankers. I'm sure Klaas in his address in a moment will be telling us also about where the fiscal authorities can come in. So it's my great pleasure to introduce indeed Klaas, the governor of the Nederlandsche Bank. That is the prelude to a panel discussion that we will hold over the following hour or so, and then there'll be a second panel discussion before we close down at 12 o'clock Central European time. But first of all, very pleased to have you here for this joint endeavor, Klaas. Perhaps I could just guide you into your 15 or 20-minute speech on what are the really vital prerequisites for European capital markets. We'll then have a Q&A between us before you absent yourself. Everybody's invited to take part in the Q&A in this session and also other sessions through the famous chat box function, which I'm sure you all know how to use. So without more ado, welcome, Klaas. Over to you. Looking forward to your remarks.
Well, thank you, David, and let me start by thanking all of you for being here with us today in this seminar. So let me start with a little bit of an analogy. If you travel by train from the city of Bordeaux southward to Spain, at the border you will experience something slightly strange. Since the rail tracks in France and Spain are of a different width, the rail bogies, that's basically the wheels of the train, have to be replaced. And then a very heavy machine lifts the train up, the bogies are rolled away, and they're replaced by others. It takes about 1 hour before the traveler can resume his or her journey. And this remarkable example of systems that do not really fit together, and that reminds one of the 19th rather than the 21st century, I would say, is not uncommon in European capital markets. That becomes clear if you compare it, for instance, with the United States. Consider a US investor located in Iowa who wants to invest in a firm located in Florida. Information on the firm's finances can be readily accessed via the Securities and Exchange Commission, while securities and insolvency law are, of course, similar across states. Now consider the same process for a Belgian investor aiming to invest in Portugal. Firm information is scattered across business registries, while the investor has to accustom itself to various local rules. This goes from small discrepancy, such as the rules on shareholder disclosure, to large differences, such as insolvency law. Whereas large areas of the European economy have become more and more integrated, capital markets in Europe are still fragmented to a large degree. And this results in real costs. The Capital Markets Union has therefore clearly moved on from being a nice to have to a need to have. Why is a unified European capital market important, and how do we get there? That's the topic of today's webinar. I think the importance of this topic is already reflected in the quality of the speakers we have on the agenda for today. So allow me to thank once more all the speakers for being here, and I look forward to our exchange of insights and ideas. Being the first speaker, my aim is to set the stage for fruitful discussions in the later sessions. In my remarks today, I will first briefly share my view on why the Capital Markets Union is so important. As the potential benefits of the CMU are numerous, I will stick to why the CMU is important for us as a central bank. Second, I will put some guiding principles on how I believe further progress in this area can be made. For us as a central bank, the Capital Markets Union is key to a more resilient European economy. Well-developed and integrated capital markets lead to more risks being shared privately, reduces systemic risk, and stimulates diversification of the funding mix of corporates. This will also help our economy to recover from the COVID-19 shock. The Capital Markets Union is therefore highly relevant to our central bank mandate of ensuring economic, financial, and price stability. So why are these goals important? Well, to start off, we know already from the financial and sovereign debt crisis 10 years ago that the European economy proved fragile. More specifically, it lacked proper risk-sharing mechanisms. Moreover, an over-reliance on banks and the financial system led to additional risks. Risks were mostly concentrated within countries on banks' balance sheets. Ultimately, bank losses had to be borne by the public, while new lending was constrained for years. You could say that Europe lacked a spare tire to raise new financing for firms and speed up the economic recovery. In response, we have made various changes to the institutional framework to support resilience of the financial system and to foster financial integration. We have reduced risks on bank balance sheets through uniform European supervision and increased capital requirements. Moreover, the resolution mechanism offers a backstop mechanism in case a bank runs into difficulties. Less progress was made, however, on the sharing of risks, in particular through private channels. European financing remains too one-sided. Firms and households depend too much on banks, and the home bias of investors is persistent. These forms of fragmentation and concentration make the economy vulnerable to shocks and increases systemic risks. So how did our financial system contribute to coping with the current COVID-19 shock? Partially as a result of past regulatory efforts, the banking sector has done relatively well so far. It helps, of course, that this shock did not originate from the financial sector itself, but is strictly exogenous to it. Supervisors have also helped to prevent financial amplification by giving room to banks to use their capital buffers. Central banks have also intervened on a massive scale to ensure financial markets continue to function and to provide credit to the real economy. In particular, central banks have supplied banks with additional liquidity to incentivize them to lend to the real economy. A cruel property of this crisis is that the countries that were most vulnerable at the outset have also been hit the hardest by the COVID-19. Governments have therefore taken an important step towards public risk sharing by setting up the Recovery Fund. What I find crucial in the Recovery Fund is that it supports public investments that strengthen economic growth potential in the financially more constrained states. The Recovery Fund helps to absorb the current shock with the aim of reducing future fragilities as well. And by doing so, we hit two birds with one stone. That being said, paving the way for a successful recovery will also require private investments. And given the bank-based nature of the European economy, it makes sense that most measures taken in response to the crisis work through banks. However, the irony is, of course, that this may increase the focus on banks in our financial system in the longer term. And this is not without risks. Because the crisis drags on, banks are inevitably going to take a hit on their loan books. And this might make it more difficult for them to keep credit flowing. Therefore, we need additional funding mechanisms to support the economic recovery. And that's also a key lesson from earlier crises. And finally, even with public risk sharing through the recovery fund in place, the need for complementary risk sharing through private markets remains high. It is important to note that the recovery fund is temporary. And I think this makes sense. A Europe that is kept together through large transfers of public funds is vulnerable from a political perspective. By developing private risk sharing capacity, risks are borne by the parties that have agreed to carry risk and are shared by a larger number of them. This should lower the effect of a shock. It would also put less strain on the banking sector, as well as on monetary and fiscal policy. As you undoubtedly know, in countries with well-integrated capital markets, like for example the US, private risk sharing absorbs much more of a shock than public risk sharing mechanisms. All in all, the potential benefits of capital markets are very significant. And that's why we need a well-functioning capital markets union. So in terms of progress with our capital markets union, where do we stand today? The European Commission has launched several proposals over the past 5 years, and many of these initiatives are now implemented. They are clearly a step in the right direction. We have harmonized rules in various areas of financial markets, for instance, on investment funds and prospectus regulation. However, it is also clear that the progress on the CMU has been rather slow. Banks remain central to the European financial sector, while home bias and wide differences in corporate funding costs remain persistent. So why is realizing the capital markets union so challenging? First of all, it is not always clear what barriers stand in the way of market development and integration. This is because capital markets are much more heterogeneous than banks. So to push the CMU ahead, you likely need a mosaic of small but interlocking measures. The next CMU working group, followed by the high-level forum, have already laid important groundwork on identifying such measures. Another challenge is that competing national interests make realizing the capital markets union difficult. Even though all member states acknowledge the benefits of the CMU, specific measures often cannot muster enough political support. This is to some extent understandable, as many of the regulations relevant for CMU have been put in place to serve other public objectives as well. I think insolvency law is a case in point here. I am happy to see the European Commission has recently launched a new action plan to push ahead with Capital Markets Union. Although I'm not directly involved in further developing these proposals, allow me to share 3 observations on what I think is necessary. First, we need to prioritize. The list of potential benefits of the CMU is long, and as a consequence, the goals that member states pursue through the CMU can diverge widely. In the new action plan, the European Commission has already brought more focus in the debate by separating initiatives on, for instance, digitalization. The next step would be to further flesh out the measures that should be prioritized in order to bring the CMU ahead. And I'm optimistic that the Commission, together with the member states, will succeed in doing so in the next few months. Second, we need to focus on further harmonization of market practices, rules, and regulations. Divergence between national frameworks in the EU is often the most cited barrier to cross-border investments. For instance, the disparity between rules and practices regarding insolvency frameworks remains sizable between member states. The speed of resolving insolvency procedures can vary within the EU between 5 months in one place and more than 3 years in another place. Different rules lead to uncertainty on the relevant right and obligations. I admit that harmonization of these frameworks is sensitive and complex. Furthermore, as I mentioned earlier, national insolvency frameworks are often designed with other public goals in mind as well. Yet, if we really want a CMU, we need to take action in these fields. And this could be done by focusing on harmonization or minimum standards of specific elements, for instance, the length of legal procedures. Third, we must value all steps in the right direction, even the small ones. The functioning of capital markets is complex and different types of players are involved. It is likely that there's not one single initiative that will make the difference. Rather, obstacles need to disappear gradually, similar to the single market. To give just one example, we have to increase the availability and comparability of firm information, for instance, through a single access point. Information is now frequently scattered between national registries, and this is therefore a crucial step towards a more integrated market. However, this requires intermediate steps to be taken first. For instance, the harmonization of definitions. The new CMU action plan shows ambition, and the scope of proposals is right. Taken together, these proposals mark an important step in further developing and integrating our capital markets. I'm also pleased to note that many of the attendees here today have spoken in the past in favor of the need for further steps in realizing the CMU. And this momentum definitely seems to be there. At the same time, various proposals remain sensitive, complex, and can be difficult to realize. We thus need member states to be ambitious and to commit themselves to reforms. We also need supervisors and industry representatives to keep thinking along on how we can make capital markets function better. In Europe, we have seen time and time again that we can converge in pursuit of a common goal if we are really committed. My hope would be that the CMU will be the next exposition of that quality, and that in the future, the rail tracks of our capital markets will seamlessly fit together. Let me stop here and thank you all again for being here with us today. I look forward toward a fruitful exchange of insights and ideas. Thank you.
Yes, thank you very much, Klaas. And I think you've really set the scene also with the rail track analogy that you mentioned right at the beginning and again at the end. In this brief session where I'll be going into some questions, could I start off with politics? Because this is an eminently political subject. And as you say, it is stymied still by differences in national codes, regulations, practices, some of which are for totally understandable national reasons. Do you think at this time of crisis, when Europe is concentrating on so many other almost existential worries, that Europe will have the sufficient political will that can be summoned up to push something which sounds rather technocratic? This is not going to really grab the attention of the man and woman in the street. What can we do to promote this politically at the time of crisis that we're in?
Well, I mean, my sense is that there is a lot of political momentum behind the CMU at this moment. I mean, the Commission has just published its action plan, I believe, that the member states are sort of in the last stages of finalizing their priorities. So I think the momentum is actually there to give the Capital Markets Union a big push. Let's not forget that 10 years ago, we had a similar crisis episode. And from that episode, the banking union emerged. At that time, you could have sort of made similar arguments. Are we not too busy with fighting the crisis, etc.? Is there still time left to also think about strengthening our underlying structures? Well, I think these processes often go in parallel, and having a crisis environment also creates a certain sense of urgency. So I'm hopeful in this area.
You mentioned a whole mosaic of different steps. As you say, we have to go forward in small paces, and and look at the whole picture at the end. If you were in charge of the whole thing, Klaas, and you could press a few levers, push a few buttons next year, in all this myriad of different things, you talked about insolvency practices, which we've been talking about for years. You spoke about definitions and so on. What three things would you do if you were all powerful, that you could pull the trigger and get the trains running on the right tracks? What would you do?
Well, I guess what I would start with is to further flesh out the proposals that are in the action plan. I think many of these proposals are still defined in very sort of general terms, and this can of course be beneficial. But I think the next step then needs to be to make it more concrete and to have proper impact assessments to identify any possible shortcomings. And we should, of course, also avoid that talking about capital markets union only in general terms leads to a certain dilution of the proposals. But on the concrete proposals, I think one area where we can make more progress on is, for instance, on the transparency and availability of firm information. And I have sort of two initiatives that come to mind here. First, we should have, I think, a European single access point for firm information. And second, what would also help is a consolidated tape for market information. Now, this may sound innocuous. Of course, it is clearly not the case. These are not necessarily small steps. There was a recent report commissioned by the EC on this consolidated tape, and I believe the report ran over 200 pages or so. So it shows that there is some sturdy details in there as well. So, but it is, I think, an area that will have to be developed over time. Yeah, and then I think it is necessary to also start, although I know that this will take many years, but to start with the more contentious subjects, such as, for instance, withholding tax and insolvency law, insolvency regimes. These barriers will likely take a long time to tackle, but then the argument, of course, is the earlier we start, the better it is.
Do you think that we could develop some kind of scorecard approach? It could be that this is building on some private and public initiatives already there, but it does seem to be when there's such a lot of moving parts to this, and it's so easy to get confused between the different small but important parts, an overall scorecard that could be developed, maybe by the European Commission, but with some private market participants, and maybe with some Dutch participants as well, could be of value here. Would you back that idea, Klaas?
Yeah, I think ultimately, of course, we should judge the progress on the Capital Markets Union on whether it achieves its intended goals. So that's where we have to assess whether the CMU succeeds in promoting market financing and in promoting market integration, I would say, in Europe. And there are different ways, I think, different indicators to measure this. I think the ECB already regularly publishes information on the extent of market integration in Europe. And it makes a distinction there between price indicators and quantity indicators. And there, usually the picture that is being sketched is that on price indicators, there's a fair bit of integration already. But unfortunately, the quantity-based indicators, there the progress has stalled over the past few years. But we can also look at indicators of market development. Take, for instance, the Association of Financial Markets in Europe. They also regularly publish the share of market financing in the total financing of European firms. There you can also see a slight increase, and particularly also this year, which of course has to do with the large issuance of corporate bonds that we've seen to deal with the COVID-19 shock. And we have to see whether that is structural or whether just initiated by the specific conditions of this year. And additionally, I think it would be helpful if we could specifically track financing conditions for SMEs, because SMEs are mostly reliant on the banks. But I think apart from talking about specific quantifiable indicators, it's just as important that we continue to track progress on the Capital Markets Union as a sort of legal initiative regularly, and also report on this. And I think that the European Commission would be in the best position to do this.
Well, yes, there's a lot of ideas there. I'm sure that my old friend Philipp Hildebrand, who'll be giving the keynote in the second session, will come with a few ideas there from an investor perspective. We've also got Thomas Wiese in the second session too, who of course has played a major role in all this, and he'll be putting some more flesh on the bones of some of those ideas that you put forward. Let's go back to the big picture, because you mentioned earlier that the central banks clearly have been active. You mentioned just now also the corporate bond issuance, which has been partly a factor of the fact that the central banks are now buying corporate bonds as part of the quantitative easing. Do you think that the central bank action by the ECB and others, necessary though it may be in this crisis, does introduce a touch of market distortion, which actually goes against the fundamental spirit of the Capital Markets Union initiative?
Well, this is a story that, this is a question that probably deserves another conference, but let me make a couple of remarks here. I mean, interest rates are not just low because in Frankfurt every 6 weeks there are 25 people meeting who like low interest rates. No, interest rates are very low because there are structural capital market factors behind the low interest rates that have to do with a sort of relative low propensity to invest. We're moving from an industrial society to a more and more services-oriented society, which goes hand in hand with lower investment volumes. And at the same time, our societies are aging, which means that there is more supply of saving. So there are structural factors behind the lowering of interest rates. Now, the ECB adds onto that, obviously, by trying to push interest rates even below the equilibrium interest rates to provide monetary stimulus. But think about the world without central bank stabilization. I think if the economy doesn't manage to stabilize, I don't think you can stabilize financial markets. And in such a situation where you would have very volatile risk premia, etc., I think it would also be quite difficult to come forward with market integration initiatives as well. It is, of course, true that the ECB, to some extent, is trying to take risks out of the market. And when it does so, it will compress risk premia so that the price of risk will be compressed. But the price of risk is not zero. There is still risk pricing taking place in the market, less than would have been the case without central bank intervention. But in my view, that doesn't impede the proper market functioning. In fact, market functioning is a restriction on, let's say, the monetary policies of the ECB. If we were to seriously impede the market from functioning, that would not be in line with the treaty.
Well, indeed, I could easily see that matching up Capital Markets Union and a smoothly functioning monetary policy, which is genuinely across the board in Europe, those two things could go together. But at this time, when all sides are trying to do their best because of the coronavirus, do you think that the ECB is going to simply carry on with the job? For instance, the next big rate setting meeting in December, it's going to be a very important meeting because there will be the time of new data, new forecasts for what will be happening next year. The fourth quarter is likely to be much more depressed than many people had thought even a month ago. In that context, do you think it's time for the ECB to bury whatever differences they may be on the Governing Council and simply say, we're going to carry on with the quantitative easing, and no doubt the PEP program will continue beyond June because we think the emergency is continuing? Do you think that's a likely outcome?
Well, there's a lot of things you're asking me here. I mean, in general, I always think that we should go to meetings and try to bury our differences. And although we have different initial positions, that we need to come to some form of consensus. That's, after all, why you are meeting, I guess, in a forum like this. But I mean, the outlook is one of elevated uncertainty that I think is crystal clear. With the second wave now taking place everywhere in Europe, that's not good for the economic outlook. At the same time, we saw that the third quarter number exceeded expectations by quite a bit. That means at least that we will start from a much lower output gap than we would otherwise have thought. And we need to see how all these factors will interact and what that will mean in terms of our new round of projections that we will have available in December. And only once I see these projections, when I get a slightly better picture on the economic outlook, then we can say something about the monetary policy stance. It is, of course, clear that recent developments have not been good, and that we have a second wave. It will weigh on the economic outlook. It will weigh on the price stability outlook. At the same time, there are also still a number of uncertainties that will hopefully be resolved in the coming days and weeks. Today, hopefully, one of the uncertainties, or at least today on the other side of the Atlantic, will be resolved. We have the Brexit still around. So I think in general, we will have a much wider set of information available to assess the outlook. And then, of course, in the second step, we have to think which instruments can we use under what circumstances. The effectiveness of our instruments is also stage dependent. So we have to look at what is the specific stage that we encounter in the outlook, and which of the specific instruments might be effective in trying to counter some of that of these undesirable developments.
Well, thank you for giving us a bit of a preview to what might be happening in December. Is there something like a kind of Keynote law that says that if a certain number of parameters enter into place, then that is a good case for ending the PEP on time in June? And you might think that 3 of those parameters might be a couple of quarters of fairly decent economic growth, the closing of the output gap, which you mentioned already, and maybe real gains in fighting the pandemic. Would that be accurate as a formulation of a law that one might put, or a code, preconditions for bringing the PEP to an end?
No, if we had such a law or code, then probably we would have sort of published it or found another way to commuate it. But
I'm giving you the chance to publish it now.
No, well, I mean, we all know that it's an emergency program, but now that uncertainty is again elevated by the second wave, we are still in the emergency. And it's, of course, you can sort of talk a bit in qualitative sense about when an emergency ends, when sort of the uncertainty should be greatly reduced. We should have some stability in the economic outlook. Indeed, the output gap will play a role. Relative market calm. At this moment, markets are tranquil. Let's hope it stays like that. That's also one of the prerequisites. But there are many factors that come into play when assessing when an emergency is over and when we return to, let's say, normality, also in terms of deployment of our instruments. At this moment, it's enough, I think, to conclude that we're not out of the emergency, and we will come back to you once we think that we are out of the emergency.
Well, thank you. We've just got a few minutes to go before we start the first panel. So you gave me the right cue for this. You mentioned the American elections. Let's hope that the right outcome comes about as a result of this election taking place today on the other side of the Atlantic. You mentioned also earlier on the recovery fund is supposed to be temporary. A classic question, which I'm sure you've answered many times before, is this really a Hamiltonian moment?
No, I don't think it is a Hamiltonian moment. Actually, I mean, there are many differences if you look at that analogy. The Hamiltonian moment was that existing debts of the states were mutualized, right? We're not talking about existing debts in the euro area being mutualized. We're talking about one specific project, which will be mutually funded by mutually issued bonds. But that's different than, and that's a far stretch from mutualizing existing debt, as was the case in the so-called Hamiltonian moment a few centuries ago in the United States. So I think that's a very, very far-fetched analogy.
Good. Well, thank you so much for bringing that to a conclusion here. We've spoken a lot about the different bits of the mosaic that needs to be put into place for the Capital Markets Union. It's a system of trains running across Europe at the moment, which are slightly dysfunctional because they sometimes have to stop at the border. So thank you for that analogy that you put forward. I think it's been very good to have the nitty-gritty view from the president of the Netherlands Bank about what is actually needed as part of this very important advance that I'm sure Europe will be making in coming years. So I'd like to thank you and all the rest of the team at the Netherlands Bank for putting together this seminar. I believe you may have to get on with pressing matters of business, but please stay on the line, Klaas, for the rest of the session to the extent that you can. I'm now going to introduce the other panelists, but I'd like to say I hope we can meet again before too long in more pleasant conditions. But in the meantime, thank heavens that we do have all this technology, which does make our lives somewhat easier. So thank you very much indeed for your remarks, Klaas. And I'm now going to ask the first panel to step up technologically to the platform. So please, over to the panel. Thank you very much. And I think Klaas has given us some really good food for thought. I've got the first panel I'm introducing. It doesn't look terribly gender mixed, does it, so far? But we will rectify that, ladies and gentlemen, later on. I'm going to introduce the panelists now in the order to which, in which they're going to be speaking. They will start off with just 3 to 5 minutes each. We've got Ashok Bhatia, who's the head of the Office for Europe of the International Monetary Fund. After that, we have Andrea Beltramello, who's the member of cabinet for an economy that works for people at the European Commission. We have Christian Rebegen, who's from the Treasury General, Ministry of Finance in the Netherlands. Sergio Nicoletti Altimari, who's Director General Macroprudential Policy and Financial Stability at the European Central Bank. And then Eric Nielsen, looking as bright and breezy as ever, who's the Group Chief Economist from UniCredit. You look as though you're training to be an airline pilot, Eric. You look very professional with your super headphones. So thanks for being with us.
This is not very modern. I apologize. It's not very modern, but we haven't figured the other one out.
Well, it's tried and tested, I'm sure. Ashok, let's start with you. Klaas spoke very compellingly, I think, about the overwhelming public policy reasons for a genuine capital market union, not only to lay off risk, but also to help markets function better and to help the economies function better. From a public policy International Monetary Fund perspective, could you just talk us through the main reasons why you at the IMF are backing this, and also give us an assessment of how well you think Europe has been doing so far?
Sure, and thank you for having me here. I think I'd like to start by congratulating Governor Keynote for really trying to give a nice narrative to a project that sometimes struggles to capture the public imagination. A wonderful rail track analogy. We at the fund invested a good amount of time last year into looking at CMU. A few words about why we need it. The lie of the land, as it were, in Europe is one where traded financial instruments, whether it's debt securities or listed equity, form a much smaller share of your average company's capital structure than in the United States or the UK or Japan. In other words, a much more bank-dominated system. Also, when one looks at European insurance companies, private pension funds, and so forth, one sees a lot of home bias, meaning not that they invest in Europe, but that they invest in their home countries. So we have a sort of mixed bag of relatively underdeveloped capital markets and relatively insular ones. Now, there are good reasons for this in part, and the comparison with the US isn't always fair with the history of Glass-Steagall and whatnot. Europe has a much heavier dependence on SMEs, small firms that naturally turn to banks, better developed public pension funds, which may explain a smaller private pension industry, and so forth. Nonetheless, we think there are important costs in the current state of affairs. We broke them into 3 things, basically. One, uneven corporate funding costs. And here I could, at risk of belaboring the rail track analogy, another thing happens when you cross the border from, say, Austria to Italy, and that is that an absolutely identical firm in almost every respect, in virtually every respect, will pay more for its funding, significantly more, if it is domiciled in Italy than if it is domiciled in Austria. I can recap some numbers on this later if you wish. But so a sort of uneven playing field in terms of cost of funds, constraints on access to finance for startups and the sort of firms that typically don't have much by way of collateral to offer to banks. And finally, another thing that Governor Keynote mentioned, which is a sort of paucity of private risk sharing. And here, just the simple idea that, if I'm a firm in country A and my equity is held by investors in country B, if something bad happens to me, the hit, my share price hit, is taken by investors elsewhere. And, this works both ways and results in a healthy cross-border risk share. I'm tempted to go into what one needs to do to get there, but I'll just stick to one thing, which is, we at the fund are delighted that both Thomas Wieser's group and the Commission have embraced this idea of a single European portal for access to company information. It's something that's been in place for a very long time in the United States, and is, I think, something that is relatively politically uncontentious and hopefully doable over time. Finally, just very briefly, trying to draw a link between all of this and the current crisis. Probably important to note that this project, of course, predates COVID, and it predates Brexit for that matter. But in terms of linking it to where we are now, I suppose one thing to observe is the surge in precautionary private sector savings with the COVID pandemic, a surge over and above the structural factors already mentioned. So yes, to the extent we can get markets functioning better, we can mobilize that money for investment.
Well, thank you for summing that all up, and thank you for mentioning again the single information portal, which of course Klaas also brought up as an important stepping stone. I'm now going to ask Andrea from the European Commission to speak about what the Commission's plan is here. And Andrea, can you now speak?
Thank you, David. Good morning, everybody. It's a pleasure to be here. Thank you for inviting me to speak on behalf of the European Commission, in particular of Executive Vice President Dombrovskis, which team I work. So indeed, I think we have made a lot of progress in the last years in our plan to integrate EU capital markets, so on the Capital Markets Union. I know that there has been a bit of a narrative that progress on Capital Markets Union has not been, let's say, fast enough. However, I think going back to an analogy that I found very good from Governor Keynote, this is about the mosaic of measures that need to be put together. It's not about having, let's say, one big bang silver bullet. It's about putting all these measures brick by brick, step by step together. But I think it's fair to say that now we need to go further still. And this is because I think we can also all agree that today the Capital Markets Union matters even more than ever. I think the defining reason why this is the case is that we need the Capital Markets Union for the recovery. So we need integrated capital markets to create more financing opportunities to help both small companies but also large companies to access different sources of funding so that they do not rely only on banks, as many European companies do at the moment. We also think that it's important that the Capital Markets Union help generate the massive investment we need for the green and digital transitions. I think public funding would be very important. This is why also the Commission has put forward the plan for the recovery. But this simply will not be enough, especially at a moment where public finances are under strain. So we need private funding for that. It's also important for a more inclusive and more resilient economies. I think it's clear that today Europeans do not get the most out of their savings because they lack confidence to invest in capital markets. But if we want them to invest in capital markets, we need to create more opportunities for Europeans to save, to invest safely for their future. So in a way, it must come from different sides. It's a question of financial literacy, but it's also a question of providing a good investment environment also through regulatory means. The other issue is that we still have 27 different national capital markets that are neither fully developed nor fully integrated. And again, this is particularly important in light of Brexit, we have Europe's biggest financial center, which is leaving the single market. So we think it's important to boost the global competitiveness of European financial markets, not as a means to itself, as an end to itself, but rather as a means for companies to become more competitive on a global stage, and also to strengthen the international role of the euro, because to have a strong currency, you need to have strong capital markets behind it.
In that context, Andrea, could I just ask you about the importance of the borrowing that's going to take place for the recovery fund? You may see the bonds maybe at the end of the second quarter next year. That it could indeed boost the international role of the euro. Do you think that will also have a knock-on effect, have some positive repercussions on the capital markets union plan? If you could answer that question briefly.
I think so. I think on both sides. So we need the capital markets union for the success of the recovery plan, because we need strong capital markets also here in Europe for that borrowing in large scale to be successful. And on the other hand, I think that the recovery plan can have a positive knock-on effect on capital markets union, because we're going to build a curve of different maturities going from short-term to longer-term maturities, which I think are going to be very important to develop European capital markets.
Well, thank you. Let's go on to Christian now from the Treasury General at the Ministry of Finance in the Netherlands. I know that you want to talk a little bit about the politics, and we've heard a lot so far, very comprehensive, very compelling, about why we need capital markets union. We haven't heard so much about how it really will materialize. Could I just put to you a question that's come in from the audience? Audience members have been very active already. I've got a whole host of questions, so I'll just put this question to you, Christian, which you can use as to introduce your remarks. And I'll read it out verbatim. The effects of not having a CMU are silently but inexorably materializing in a weaker economic performance versus the US or China. What would make European politicians really trigger decisive support and actions to accelerate CMU for Europe's benefit?
Well, thank you, David, and it's an honor to be here, and good that we can have also this format, even if it's in a digital context. And thank you for the question. I think it's a very relevant question, especially now we see after the first spike in the Corona crisis, where we've seen many governments giving support. We've seen many banks doing their work, but it also has shown clearly that we would really benefit from a better functioning capital market. So, and honestly, I'm afraid that if you know and look to the needs for solvability support, I think that the urgency of the important work of developing the capital market can only become more clear. It's especially important for the banks. So then the question is, of course, what should we do, and how can we?
And what would be the triggers to? The politicians have a lot to worry about in other areas. So what are the triggers to push the politicians into action? That's what the question I would like to know.
Yeah, and I think there is the more neutral issues which have been mentioned by many of the other speakers. I would say the information points, improving transparency, in the Netherlands we have good experience with banning inducements, etc. So I think all of those are crucial from the Netherlands point of view. The more sensitive issues are related to, let's say, insolvency regimes, as Klaas mentioned, withholding taxes, but also there, I think we have to make progress. I think what you see actually is that this crisis does show that issues which were before not feasible have now become possible. Well, I mean, the example of European bonds is an example from my country, because the political position in my country is that we are completely against any issuance of European bonds, because we are convinced that the budget should be financed through national contributions. So look what happened. There has been a compromise in Europe. Countries have, let's say, stepped over their initial positions, and now we have, although it's temporary, an issuance of European bonds. I think on solvency, we finally reached.
Christian, is it really temporary?
Well, that's of course the political position of the Dutch government. We had European bonds earlier for specific issues, and we think this is a very specific constellation. But I just give it as an example to show that the urgency of the current situation does trigger political parties to take steps which they've never done before. And I think that's important. Supervisory framework. I mean, it was completely very difficult, let's say, last year to come to a compromise. And hopefully this situation can help everybody. That we need more convergence on supervision on the capital market. This is crucial. I know the Commission has the same position, and we completely aligned with them, because we need to make steps if we really want this capital market to function.
Well, thank you for introducing all those subjects. And I do think that the crisis, as we've always known ever since the days of Jean Monnet, has been a great generator of political developments in Europe. Let's go over to Sergio now, speaking from the prudential point of view. You've got some very interesting thoughts, I think, to say also about the non-financial intermediaries in Europe, and also how the ECB is keeping tabs on that. So can you address these issues, please, Sergio, from an overall ECB viewpoint?
Thank you very much, David, and thank you for the invitation to the organizer. Yeah, indeed, I wanted to touch upon some preliminary lessons that can be drawn from the COVID crisis for the development of capital markets and the capital market union. And I wanted to stress essentially 3 points. First, I think the crisis has highlighted the advantages of the increasing role of the capital markets and the non-bank financial sector playing in financing the real economy. The progress is still insufficient, but and we are still far from the level reached in other advanced economies. But the system is becoming a bit less bank center. The non-bank financial sector has increased very rapidly since the global financial crisis. In the euro area now we have a situation which its assets almost doubled and now represent about 55% of total financial sector assets. And this is also reflecting the growth of market-based credit to firms, which now accounts for about 20%. It started from a very low level, less than 10% a decade ago. And the benefits of this trend manifested themselves, in our view, over the summer, in the recovery period after the big shock in the spring, when capital markets with record corporate bond issuance significantly helped non-financial corporations to bridge their funding gaps. And importantly, especially in this juncture, to shift their debt towards longer maturities. On the buyer side, non-bank entities absorbed the vast majority of the bonds.
No, there is the video.
A bit of interference. Maybe other people could cut their microphones while Sergio is talking, because we seem to have several voices on the line. Thank you very much. Sergio, please carry on.
Sure, thank you. And this increased activity in the bond market has helped also to keep a very favorable financing condition, which is really a prerequisite for sustaining the recovery. And it's a role that will become even more important in the coming months as we confront, as was already recalled, the deterioration of the economic outlook, and as bank financing may come under increasing pressure.
Sorry to interrupt, Sergio, but it's very important what you've just said. Are you saying that the quantitative easing programs of the ECB, far from distorting the market, as I was suggesting earlier, actually are helping market functioning? They are encouraging a lot of corporate issuance. I know that's not the main reason for the asset purchases, but would you qualify that as a favorable supporting factor for the development of capital markets union?
Absolutely, yes, because I think the intervention of the European Central Bank, especially at the height of the crisis, was also meant to restore market function. And this is because this is a prerequisite. Market function is a prerequisite for a smooth transmission of our monetary policy impulse. And so that has been absolutely key. And then as sort of kick off also the restart of capital markets, and especially the bond issuance that we have seen over the summer.
Well, thank you very much indeed. We will be getting deeper into the ECB's role in all this as we go on with the conversation. I'd now like to turn to Eric Nielsen, who's going to speak really on behalf of the private sector here. Eric, you have the disadvantage in a way of speaking last, but also you're a very brilliant chap, so you'll be able to tell us all kinds of new things. I have to say, I think it's a very good news that Piercarlo Paduan is going to be your chairman now, replacing our old friend Fabrizio Saccomanni, who unfortunately died more than a year ago. But he is a very great supporter of what we're talking about here, isn't he? And I think he will be providing a very good push also at the political level, at European level, for what we're talking about here. But Eric, looking forward to hearing your thoughts.
Thanks, David. Thanks for inviting me. Let me, yes, I share your view that we are very lucky to get Mr. Paduan as our new chairman, but I should emphasize that I certainly don't speak on behalf of him or the board or the bank. I'm research, so let's just be very clear on this. A lot has been said that I agree with, so I can be really, really quick. Maybe three or four quick points. I think you have to, I'm speaking from a bank, I think you have to acknowledge that capital markets union and banking union hang together. We should have more capital markets union, but so long as we have an economy that's in Europe that is so dominated by SMEs, one has to, at least it's a many decades before the banking system would be unimportant, if you will. So you have to sort of think about these two things together. Number two, I completely echo Klaus Nord's point on more risk, private sector risk sharing. This is what we need. There is lots of research on this that shows exactly as you said in America and other big unions, that is the private sector that provides most of the cushioning in when you have asymmetric shocks. In that context, we also have to understand and appreciate that we have come to a stage where if you have taken no risk, you will get no return. And this applies also for the private sector and for the depositors in the surplus countries, that the idea that you have a God-given right to put the bank in the money in the bank and get a positive return without taking any risk is not really there anymore. So let me say two things about the capital markets union and on the bank side. The first thing is, of course, it's a matter of incentives. At the end of the day, we can encourage more cross-country risk-taking through the regulatory and tax regimes. The simple thing in capital markets union is to change the tax system. It can be tax neutral to encourage equity over debt, and we should. The second thing, of course, is that we can encourage cross-border risk-taking, and that applies also in the capital markets union, but it also applies for the banks. You could give, for example, a regulatory credit to banks which diversifies its risk over geographical regions. Nicolas Véron and others have suggested this, and I think it is a reasonable way to think about it, simply to encourage the cross-border capital movements via the banking system. And then there is, of course, the issue, as you said correctly, and I completely agree, information on different regimes. In the ideal world, I thought Klaus Nord was going to answer your question, David, if he was God of the whole thing, that you just make one legal framework for the whole Europe, but that's not realistic, of course, for many years. So one has to find a way of getting around this, and one way in the banking system, but there's not the key topic here, is some sort of a branchification maybe of banks somehow, so you can take the risks and you can think about cross-border banking to support also the capital markets union across the various countries. At the end of the day,
since you mentioned banking and cross-border banking, is the answer indeed that there should be more cross-border banking mergers? I know we've been talking about that for years, but do you think that 2021 will see any advance on that thorny subject? We don't have a German panelist here, but the key to all this, I think, is Germany. That Germany's got a lot of relatively poorly functioning banks. And if somebody was to take over the Commerzbank, for example, if somebody was brave or foolhardy enough to do that, it might actually start up a lot of very useful mosaic stones all rolling in the same direction. What do you think of that?
I think we should have more cross-border banking because banks is a service industry that service the real sector, and the real sector works across the borders. So it's a very simple answer, yes. But here's the fundamental problem. The fundamental problem, as far as I can see, is there's political issues involved, but then there are the regulatory issues. But the key problem, David, I think right now is that no bank in their right mind would merge now, because our share prices are somewhere between 25 and 30% or 50% a book. Nope. If you're running a bank, I'll be very blunt. If you run a bank today and your share price is trading at half book or thereabout, the only sensible thing is to buy back shares as much as you can, close down business. There's not a one unit inside a European bank that can have a return on capital of 18%, which would be what you get by buying back your shares. And if you merge, yes, it is a relative price matter of relative price between the banks that merge. But when you merge, you always have to issue new debt to pay for the consolidation, all the rest of it. And you shouldn't issue equity at a time when you're trading at these levels. So that sort of led me to the last point I wanted to make. One has to appreciate to a larger extent that I see in the private or in the public debate that banks are just commercial entities. We are competing with every other company in the world for capital. We are told we have to have certain capital, which is good, but we are competing. And over the last 10 years, we have been just about the worst sector in terms of return. So how do we persuade people to keep the capital with us?
Yeah, well, thank you for putting it like that. And I think you've summed it up brutally, the reason why we're not going to see very much progress and cross-border mergers. I remember Joe Ackerman saying years ago that Deutsche Bank had to make 25% return on equity, otherwise somebody would take it over. Well, clearly we're a long way from that. Can I go on to another question for Ashok, please? We've got a range of really good questions from the audience. Please do keep the questions coming in, audience members. This relates to a classic IMF public policy issue of inequality, and it's a very wide question for Ashok. How can Capital Market Union deal with inequality of income, wealth, or economics within regions and member states? Question mark.
So I think part of the answer there is something I've already touched on, which is this idea of seeking to achieve a more level playing field across countries. You know, the notion that two firms of the same industry making the same product with the same leverage and the same tangibility, i.e. collateral to offer or not offer, should have such different funding costs simply based on domicile. So, you know, I mean, there's sort of unevenness or inequality right there. And then from the investor perspective, of course, capital markets are about increased choice. The idea that, you know, both sophisticated and retail investors should be able to find places to put their money fruitfully beyond simply bank deposits. So let me stop there.
Yes, I can see that what you mentioned yourself, the differences in the cost of capital in different countries being very uneven. I can see very much that when we get to that final point, Capital Markets Union might make a difference in that. I mean, maybe that's something the politicians need to make somewhat more explicit. Another question for the audience, I think, which is very much focused to you, Andrea, from the Commission. The question is, would it be not appropriate that some of the new CMU plan be proposed as definite EU regulations The questioner mentions the MiCA regulation, for example, and it goes back very much to this idea of scorecards, building blocks, bricks, all the different mosaic stones. The questioner says, unless we build the core building blocks, the whole CMU plan might end up as just good intentions, but a very, very slow solution that we'll still be talking about in 5 years. So it all does come down to this very nitty-gritty question, which I'm very pleased Klaas mentioned about the individual building blocks. Can you help us at the Commission to put those building blocks together?
Well, I think you're going through an open door with that question, because in the Commission we are big fans of regulations over directives. No, I mean seriously. Of course, we think that moving towards more regulations and less directives is a part of building a uniform rule book for capital markets across the EU. I think that's natural in a way. We propose regulations when it makes sense to propose regulations, though the question mentions MiCA or the proposal for a market in crypto asset, which the Commission very recently put forward. And there, obviously, it made sense to have a regulation to set, for example, uniform harmonized rules when it comes to markets for these new crypto assets, including, for example, the so-called stable coins. But more generally, it comes to what kind of regulation and supervision we need in a more harmonized capital markets, in an integrated capital markets. We definitely need to move more towards a single rule book, and we need to move towards more convergent supervision of those rules in the EU. This is something that the Commission had already promoted with the previous action plan, where we put forward a review of the European supervisory authorities to improve convergence, to make supervision more uniform across the EU. We did not succeed, I would say, to the extent that the Commission wanted. Mostly, must be said, because of opposition from many member states, unfortunately. However, we are not ideological in this in the Commission. We want to move to more harmonized rules and more harmonized supervisions where it makes sense. We've seen recently cases where supervision has not been as let's say, as effective as it should have been. And it makes sense, therefore, to draw lessons from these cases and see what more can be done at European level. But again, in a pragmatic, not ideological way.
No, thank you. I want to put the same question to Christian in a moment. Just while we're with you, Andrea, this scorecard approach, under which you actually mark the card of individual countries and give them marks out of 10, for example, for individual steps that they make in all this great assembly of mosaic stones. Does something like that exist, which needs to be done independently? And if not, should that not be something that we try to set up so we can actually record the milestones and see how well people are doing? Just a quick answer, please, Andrea, on that.
Yes, we're working on what kind of indicators we need for Capital Markets Union. Maybe a scorecard of member states would be a bit simplistic in that respect, but it's definitely something that we need.
And I think people like simplistic things because they can relate to them. I mean, I don't think there's anything wrong with simplistic things. But anyway, I mean, I think let's develop that further. Christian, back to the building blocks. I think the question is a very good one. Andrea says, slightly jokingly, he likes regulation, and indeed, good regulation we all like. What is your answer to that question about the building blocks?
No, I think it's an excellent example. I think for the Netherlands has together with France and Germany been really pushing this agenda, let's say from a year ago with our own group starting coming up with ideas on the leadership of Mr. De Marny. He will be in the next panel, and for us, so for us, we've been really pushing this. And well, many subjects, I think the Netherlands is not very active, let's see, promoting more central European coordination. But I think on this area, we've been very, let's say, progressive and constructive. And I'm sure Andrea could confirm that we wanted to have more central supervision. And we're not ideologic. that's why I played for a framework where you can really look some issues you can probably do better on the national level, on issues which are very close to, let's say, consumers, and to make sure that they are well protected if you want them to be involved more in the capital market products. But in many areas you clearly have to do to work on the European level, and I think this is clearly where the Commission has a value added. So I think the work of the Commission is crucial, and I think what they've done so far has been very helpful, and simple blocks and graphs I think work perfect also for our politicians, because if we go to our parliament, honestly, it's quite difficult to explain what is actually a capital market union. So we probably have to look for different words, what it actually is and what it can bring.
That's a good point. Again, perhaps we do need something more simple to explain even to parliamentarians. Just while we're on this political subject, Christian, a quick answer, please. How well do you think the German presidency has done on capital markets union in the 6 months where Germany has been in the driving seat? Have we seen any progress at all, quite bluntly, in this 6 months?
Well, I think we have seen progress, and I think I know my German colleagues quite well. They are very committed to make progress, and of course the circumstances were not ideal with COVID and all of that. But I think there is a plan. There are on the individual trajectories they've come up working on the proposals together with the Commission. So yes, I'm quite happy with what they've done so far.
Good. Well, let's go to Sergio. I've got a question from the audience about central banks, and it's a question whether the capital market union and the objectives thereof and the ways that you go about trying to form capital markets union could clash with central bank objectives in terms of questions like bank solvency and so on. Sergio, from your standpoint at the European Central Bank, do you think there could be a clash of objectives here, that you might therefore lose focus on monetary and financial stability because you're so keen about setting up capital markets?
Thank you, David. No, I think actually the very opposite is true, in the sense that from a central bank, I think my colleagues have mentioned many of the advantages that could come with capital market union. From our perspective, from the ECB perspective, one of the main advantages actually is that it could improve the transmission mechanism of monetary policy and make it more smooth, the transmission monetary policy across all member states. And this is crucial in our view, because especially in a recovery phase and in a situation where we are, where the speed of recovery is very different across country, this is going to be a very crucial element for us. To rely on well-functioning, deep and integrated capital markets and be able to transmit the impulse of monetary policy in a much more uniform way across member states.
While we're at the ECB level, is there a working group or a cross-departmental unit or set of units at the ECB, Sergio, that's dealing with capital markets union? Because it's something that cuts across different levels of competence and different sectors. Is there a unit at the ECB that maybe is the sparring partner with the European Commission on issues to do with capital markets union?
Yes, actually, we cooperate a lot with the European Commission. We were observers, by the way, in the high-level forum on capital market union. So we interacted a lot also with Thomas Wieser. We have indeed a sort of cross the departmental task force that looks at the capital market union and more generally to financial integration in Europe. That for us is one of the priority of the European project.
But could we see, for instance, some joint reports from the ECB and the European Commission on things like that? Because I think it's very important to stoke up public awareness of this. Both of you, Andrea and Sergio, perhaps these things exist already, but I'm sorry, I'm not aware of it, with the ECB and the European Commission both focusing on this together and forming a team
Actually, I don't know if Andrea wants to reply, but it does exist. We have financial integration conference every year, once at the Commission and once 1 year at the ECB, and we draw common lessons and also actually write reports. Yes.
Well, maybe it needs to be made more simplistic, like so people know, like me, know about it, and more seriously, so it gets into the public domain, because it is a question of getting this out into the bloodstream of politicians, isn't it? Really, and I think we all agree this shouldn't just be a subject for technocrats. This should be a subject that ordinary people worry about. I mean, I'm sure we'll all agree with that. Eric, let's just go to you as an ordinary person. I've got a question from you from the audience. We've got some fantastic questions coming in now from the audience, so please keep it coming. The question verbatim is, to Eric's point, there are a lot of headwinds for banks in Europe and have been for a while. Is it necessary to have bank reforms or specific changes in overall policy as a prerequisite to a smoother facilitation of capital markets union?
That's a very good question indeed. I think there's I'm a big supporter of what the ECB has done given the circumstances, but there's no question that the combination of a flat yield curve and zero interest rates and a negative rates deposit rate is taxing for banks. But to the extent that the monetary policy has helped on the growth side, and I believe it has, the net effect on the banks is positive. So I don't like this picking one bit of pieces, because you have to look at it combined. There's also clear that the multitude of new regulations supervision that we got since the crisis, the financial crisis, is very, very taxing on time and money in banks. Again, I'm not arguing we shouldn't have it. What I am actually arguing on that score is that we ought to have one study that shows the impact of the multitude of new regulation supervision of banks. It is a bank like us, we get probably 1,000 official requests a year from regulators or supervisors of testing this against this, of which probably 20%, I'm guessing something of that order of magnitude, are so time consuming and complex it has to go to the board to consideration. I mean, I've been involved in it. I can give you examples of the amount of time it takes. It's unbelievable, right? But it's, again, I'm not saying we have too much. I'm just saying it's amazing. We got all this. It's like a smorgasbord of all public institutions being allowed to throw things at banks, and nobody has ever sat down and said, here's the totality. But I also want to say,
your answer would be to weed out the regulation that is not appropriate, as it wouldn't be new regulation, it would be a reform of the present regulation to make it actually more user-friendly for the bank.
Yes, that's well put. So at least we get a sense of what the cost is and we understand it. But I also want to say before I leave the floor that banks still need to reform themselves. I mean, we are too cost heavy, many of us. It is, and you mentioned the German banks, particularly with cost to revenue ratios of 80-90%, is completely crazy. I mean, it's and so there needs to be a further reform. And for many banks, in a sense, the COVID crisis has been a blessing in forcing a faster move on the IT side. That's very clear, and this is something banks have been before. So lots of stuff has to be done on the banking side. I'm not saying that the poor returns in the banking system is all due to policies. It's a combination of things for sure.
Ashok, the IMF over the years has been very instrumental, I think, in accompanying various changes in the European landscape. I remember very well that the IMF under Christine Lagarde, of course, was instrumental very early on in calling for more wider quantitative easing in Europe before that started on a bigger scale in 2015. Is the IMF going to tread into this area, this rather vexed area of the linkages between banking union and capital markets union? Eric made the point very well that the two are linked together. Is this an area where the IMF, in terms of your public policy pronouncements, might wade into that area even more than you do already with some beneficial recommendations?
I think the short answer is yes. We've looked in some detail at the banking union as well. It so happens that our most recent project was on CMU. It probably follows that our attention will now rotate back to banking union. I completely agree with Eric that, in a sense, the more important of the two projects remains the banking union, if for no other reason than because Europe remains a bank-dominated financial landscape. But it's more than that. I mean, I think if you look at any financial system, the reach of banks extends further than you see simply by who owns the financial assets. I mean, often banks are out there managing those assets on other people's balance sheets for fees. So yes, you know, banks, large banks in particular, are the heart and soul of capital markets. But if I may, I just want to briefly come back to this issue of sort of simple or simplistic. I think the CMU is a sort of very technical area, relatively speaking. And this is a good thing and a bad thing. On the good side, I think an awful lot can be done on CMU that does not require sort of consensus. You know, I mean, who can argue with the idea of a single portal to provide information on EU firms, for example? And there are many other examples. The risk, on the other hand, is, you know, when you start talking about medleys or mosaics or bricks, I mean, there is a risk sometimes, I fear, of getting lost in the fog, you know, a really sort of burning need to cut through that and prioritize. And we've sort of tried to slice it into three areas: information, regulation, and insolvency. Happy to elaborate on any of them as we go.
Yes, well, I think this information issue, that's really shone like a guiding spirit through this seminar so far, with Klaas starting it off on that, the information portal that you've mentioned. That's something I know a lot of credit rating agencies, for example, are very willing to help that in terms of pooling data. I've got a question for you now, Christian, from the audience, which is very much related to some of the spin-offs or the spillovers, repercussions of present monetary policy. The question says, if we believe that the current COVID response related monetary and fiscal policy is creating zombies, if we believe that, do we see in the capital markets an early warning for various sectors in terms of credit deterioration through pricing, and B, a possible exit for the holders of zombies through the packaging of migrated credit? I'm not sure whether it's meant to be migrated credit or integrated credit in the capital markets. Do we see the capital markets providing an exit for people who, either for good or bad reasons, are holding zombie debt?
Well, I think it's a good question, but it's also a complicated question. So I'm also curious to hear from those who actually are working day to day in these markets. But it's clearly, it is a risk of the current situation, and it's also one of the concerns, I think, of the Dutch government, that with all that money flowing in, looking for yields, we do support companies who actually who normally not survive, and therefore we are also. And also we alluded with the European Investment Bank, for instance, how can you actually make sure that you do get a sufficient due diligence, that you do get a sufficient return, and it's not so easy. So I think for governments, we have to be very cautious to get involved a lot in that. And I think it's really up to, I think, like banks like the European Investment Bank, who are much
well, there we are. Perhaps I could take your statement, Christian. I think you have to be cautious, definitely. I've never met a company that admits to being a zombie, although there are apparently a lot out there. But I wanted to ask you, Eric, because you are the man involved in all this. So how would you answer that very market technical but very good question we've had from the audience about getting in and getting out of zombie credits?
Yeah, this is a super important question. That's why I was raising my hand. I think I'm all for cleaning out zombie companies, but this is not the time. I mean, it is the idea of sort of creative destruction type of going after the zombie companies at a time when a tsunami of a health crisis coming through and throwing everything over. It takes more self-confidence than is reasonable to think you can pick and identify the zombie companies. Example, Are we really saying that, for example, 2/3 of the world airline industry now needs to close and go away because we're never going to fly again? Really? Is it what we saw? It's one of these wonderful, easy things to sit on a desk, but go down to my local restaurant in Berlin. Is she not going to be there because she couldn't survive this? I mean, like, this is, I find it, with all respect, arrogant for those who argue that this is a time, clean up the zombies. No, this is a health crisis, keep everybody afloat, and then we have to deal with it afterwards.
I mean, I take your point there, but the questioner was actually asking the question: if you own zombie debt, can you, and you don't want to do that, can you now get out of it? Because there's actually quite a lot of liquidity in these instruments. So I presume the question is yes, because after all, that's why the capital markets are functioning, in order to allow people to escape. Would you agree with that?
Yeah, I mean, yeah, David. Yes, David. I mean, we have in Europe developed a much better market for zombie debt being traded. If I'm not running the banks, I'm not speaking on behalf of UniCredit, but if I were a bank holding debt that looks like this, I'm not sure that I would look to sell it right now, for the simple reason that we are living in the middle of the fog. We don't know, and therefore the risk is that you are selling it at a terrible price. Really, I mean, so unless you're really
good bit of advice for the member of the audience who asked that. I think the overall point is that the normal precepts of dealing with what seems to be, rather poor quality debt, all that has been suspended for the time being because of this emergency. And as you say, now
that's fair.
It's not the right time. I noticed the German Constitutional Court, in its famous ruling on the 5th of May, did mention zombie debt, and then the ECB then mentioned it once in the statement after that. It's the first time they've ever mentioned zombie debt, and now we've gone back to normal. I agree with you, Eric. This is not the time to bang the drum on that. I'm going to ask you, Sergio, a fairly loaded political question, which comes from Katharina Nice, who now works for PGIM, having worked at the Bank of England. And this is a good question for the ECB, although I don't know whether it's a good one that you can actually answer. But how important, Catherine asks, is post-Brexit competition between Paris and Frankfurt in hampering progress towards CMU? Might Europe adopt a different, more fragmented model that incorporates, for instance, Dublin, Amsterdam, Milan, Luxembourg, etc.? Eric is smiling at this one, but can I put the first effort to answer this? I'll pass the hot potato to you, Sergio, if you can start off answering that question. It's a really good question, Catherine. Thank you for putting it. Sergio, your answer, please.
Yeah, very difficult question indeed, David. I mean, there is no doubt, that getting out of London with its huge economy of scale, global market reach, could have some consequence. Maybe not in terms of financial stability, because I think cliff effects have been managed pretty well. But in terms of cost for the industry, at least in the short term, that could be certainly there. I think if we are going to have a multipolar, say, system in Europe, there are ways, we believe, to make it much more interconnected than it is now, and work together to reach the same efficiency, the same economy scale that we have seen in the market in London.
So you believe in a multipolar system, Sergio? That would be your very simplistic answer to this, and we've got to try to make it work. I deduced that from that. Eric, you're the classic person. You're home in every European capital. So apart from Milan, where would you make the capital of the European capital markets? Well, indeed, would you go for the multipolar version?
Yeah, I wouldn't set out to design it, David. I mean, the thing, I mean, I was also smiling because there's this anxiety in London about it moving away. I mean, London will still be a big financial center afterwards, I'm sure, after all this goes through, and there will not be a continental Europe or Dublin that can match it. But I think let's go back and remember the financial sector, banks and capital markets union, is here only to serve the real economy. We are not, and I don't think, frankly speaking, there are many politicians around Europe who would like to have a financial center a la London. I mean, I lived there for 20 years and it's been very nice, but I'm not so sure that that it has not been part of the problem in Britain of the big divergence between London and the rest of the country.
Well, this
it is
goes,
not easy.
The first Royal Commission report on that was of 1850 or 1860. It is a long problem. You're right, absolutely right on that.
Yeah.
But the multipolar system whereby everybody has a slice of the cake or a bit of the cherry, I mean, would you go for that?
I would, rather than answer the question, I would say, if I were a politician or a functionary in a ministry, I'm not sure I would set out an objective to create one system. I let it go. Let it see where people want to move. It's a private sector. We don't need to have one place. But we need obviously a lot of the services inside the Euro system, right? That's I am very clear on in my mind.
Yes. Christian, were you wanting to make a point there on Amsterdam?
Yes.
Came up.
Well, basically, I wanted to say what Eric said because I think it's good that Europe is not dependent for many of these functions in the capital market union on a country or a city which is outside the Europe or outside the European Commission or European Union or the Eurozone. And how that exactly would look like, and that there is now, let's say, some concentrated in Paris and Frankfurt or Amsterdam. I think we should be, as politicians, we should be cautious. But it's important, I think, that we're not dependent. I mean, it's not on London. We are less dependent, and of course, some crucial functions. I mean, on clearing, etc. I think what the Commission did was very wise to ascertain that let's say there will be no immediate stability issues if we have a Brexit. But in itself, I think the development that some of that is moving to continental Europe, I think is a good development. It's a very good development.
I think it is good for Europe as a whole, and undoubtedly Eric is right that there has been too much concentration of financial services in London for our own good in the UK. So some diminution of that is maybe not a bad thing. Andrea, a very political question for you. Could you please comment on the areas of the CMU plan where countries have major disagreements? Don't forget, all this is totally on the record, so your pension may depend on the answer that you give to this question. So, Andrea, please comment as bluntly as you can on the areas of disagreements.
Thanks for the warning, David. No, I think this is not, in the end, such a difficult question. Okay, first of all, I have to say, going back to something that Ashok said, I'm not sure that there are areas in CMU or actions that the Commission has put forward which are fully uncontroversial. I think for any of these actions, you will always find someone who doesn't agree, who would like to stop, to put obstacles, even that action on a single access point for company information, which, as you know, the Commission is very keen on. This is the first action that we present in our new action plan. But there again, you have to consider that some companies may find it too burdensome, too costly to report that information, that for some vested interest, it may not be very interesting to have that information all concentrated in one point. So as Commission, I'm not trying to justify the difficulty that the Commission has to, let's say, face every day in implementing this plan, but we should not forget that things that to us seem to be no-brainers, for some are actually something that they would fight against rather. But leaving that aside,
just staying with you in a moment. In the past, a classic way of solving problems in Europe has been to have a Franco-German push. It seems to me that, not least because of this latent competition between Paris and Frankfurt, a Franco-German initiative in the Capital Markets Union is probably the worst thing that could be brought about in order to bring this forward. It has to be multipolar, doesn't it? It has to be many different countries doing their own thing, letting 100 flowers bloom. Could you just comment very briefly on that, in the absence of any Franco or German participants on the panel?
No, we certainly need a very large buy-in for this project, because we need 27 capital markets. It's not only about developing the big capital markets. We need also local capital markets, because some of the needs for local companies, for small companies, for investors are actually best served when they are close. So we actually, to have an integrated capital markets, we also need many capital markets to integrate. Otherwise, what are we integrating? Are we integrating only 2-3 capital markets? This is not what we need.
Point. You've summed it up perfectly. I think we need the Dutch in particular. That's why we thought it would be a very good idea to have this conference in Amsterdam, because we do see the Dutch as leading the field, really, as a medium-sized country with a lot of clout. Christian, we've got an election in a few months in the Netherlands. I don't suppose this will be in the top 10 issues that people worry about, but can we see the Dutch emerging as a leader in this field, please, Christian?
Yes, well, you can count on us, and I think together also with our central bank, and as you say, the fact that you and DNB have organized this here, this conference is a sign of that. The fact that we, together with the Germans and the French, have started this next CMU working group is also a sign of that. And yes, we are true believers of a good functioning capital market union. We are an open, mid-sized country, and we benefit from it. I mean, let's be clear.
Well, also we want to try to get the whole community. Obviously, you're very good in the Netherlands and the networking, you know, with the universities, with the research institutes, with the academic institutions, with the huge pension funds that you have. I think you've got a real critical mass actually in the Netherlands, and you can do a lot. So we can stick that into the agenda for Mr. Rutte at the next election. Ashok, a question for you now, a very macro question. Will capital markets make the system more risky and speculatively driven, as investment will be made on high returns and not on fundamentals? Eric made the point earlier that people have to be ready to take risks. The question is, will the Europeans be driven into taking too many risks as a result of capital markets union?
Well, hope is always a loaded word, but I would hope not. The idea is to have, as I mentioned, more choice, more diversification, more than one way for a firm to raise funding, more than one place for an investor to put his or her money, with a sort of healthy competition between the capital markets and the world of banking. Now, that's not to say that capital markets cannot be prone to excesses. This conference is based in a country that, of course, goes back to the tulip manias, and arguably the GFC was at its heart a capital market crisis with subprime and all that. So there are risks, they need to be managed, but that's not to say that efficiencies shouldn't be harnessed and the project shouldn't be pursued.
Well, we've got Eric, who can tell people how to take risks, and Sergio on the panel, who can try to stop people taking risks. So we've got a healthy balance here, I would say. I've got a question from John Orchard, the OMFIF Chief Executive, and maybe I'll ask you all of this in order, because it's quite a good question. You can answer it fairly simply, and then we'll come on to the final question, which I will put, which has got something to do with the United States, given the fact it is a historic day in the United States today. But first of all, the question from John Orchard, I'll put to all of you, by when, first of all to Eric, by when, Eric, might Europe have the proportion of capital markets funding to bank funding that the US has? In the US, it seems to be 80% to 20, so 80% capital markets, 20% banks. Europe is much worse than this. When will Europe catch up? In 15 years or never?
It would take more than 15 years, and I'm not even sure we want to be there. I mean, round number, we are in Europe, we are the opposite, the 80-20, 20-80. But Europe has the SME sector and all the rest of it. We need definitely more risk capital, equity, private equity, less bank proportion. But I don't see why the objective is to get to ratio.
50-50, would that be the Nielsen solution?
Yeah, if you want a headline, you could say that, but it doesn't matter, because we're looking at 2-3 decades out, and right. And maybe the structure of the real economy has changed by that time. But
I'm very sorry to disappoint you, Eric. I don't think this will make the headline in the Frankfurter Allgemeine Zeitung tomorrow. Well, Sergio, would you like to answer that question? Because you've got an eye on the big picture. John Orchard's question: when, if ever, will we get there? And do we want to get there?
Yeah, I very much agree with Eric. I think, however, one clear point is that the banking sector will have to undergo a big transformation. As Eric was recalling before, we have a structural low profitability. We have still a very high cost compared to peers. So there will be a big transformation in the banking sector. For sure, this will take years and maybe some shrinking, but I agree with him. We a well-functioning and important banking sector is also strength for the
Yes, Christian, would you like to answer that? I'm sure somebody's writing all this down, and we'll be back in 15 years to tell whether or not you've got it right. So, Christian, would you like to answer that question very briefly?
Yeah, so I agree. I mean, the percentage should get higher. I don't know if we need to get to the US situation, but 50-50, I think, would be a good percentage to strive for. And what is necessary, and in that sense, I completely agree with what Sergio said. We need much more consolidation in the banking sector. That's really what is necessary.
Andrea, a very quick point on that crystal ball gazing from you, Andrea.
I don't think we need to get to the US level, but we definitely need much more than what we have now. Otherwise, we will lose out of the competition, the global competition, to invest in the digital transition, in the green transition. All of this requires more capital market funding. Banks alone cannot do it.
Ashok, a brief point from you on that?
Yeah, the short answer is perhaps never. I think it's worth remembering that capital markets are uniquely well developed in the United States. And this in part may reflect, among many other things, half a century of the strictest separation of commercial banking from securities underwriting. But I agree with everyone that given where Europe is today, we're a long way off from a risk of overshooting. I mean, there is a clear case for Europe to push forward on this front.
Okay, we're getting quite near the end now, but I do still have questions cascading in. But I will be stopping this around about 11 o'clock, and then I'll be handing over to Art Huben from the Nederlandsche Bank, who will be starting again 5 minutes after that. He'll be introducing our friend Philipp Hildebrand. I have a good question, which is about digital currency, and I'll just put this very briefly to you, Andrea, since you mentioned this earlier. Is there an interlinkage between an underdeveloped CMU and a future potential digital euro? This again is a subject for a whole new conference, actually, but can you just give a two-sentence answer, please, Andrea, on the digital euro and how this might fit into capital markets?
Well, in the Commission, we're very supportive of the work that the European Central Bank and the Euro system is doing on the digital euro. So we are ready to support the European Central Bank in any decision it will take in that respect. So there is a consultation now ongoing. There will be an investigation. A decision will be taken by the ECB by middle of next year. And certainly we are very interested in seeing how this can help with the digitization of financial system, of the economy as a whole, but also how this can be a way to promote the international role of the euro and the competitiveness of the euro.
Well, thank you. I'm sure we'll organize a 3-hour seminar on this at some stage, because it's a very interesting question. Christian, another good question coming right at the end here for you about pension funds from Ido de Gois. The question is, the high-level forum on CMU advises us to set up more pension funds across Europe, especially in countries that don't have these funds these days. How do you see the setting up of more pension funds as an alternative to banks, actually, in order to fund industry and fund companies? So pension funds in order to help the benefits of the CMU. A quick answer to that, please, Christian.
I think one thing, there is some, let's say, relation between the matter, in fact, how pension fund systems are developed and the development of the capital market union. I think countries which have a better developed pension fund system clearly have a better developed capital market system. So let's say if this project could help to develop pension systems, and I think in the Netherlands we have a very well-functioning capital-based pension system, I think that's crucial to do so. So the answer is clearly yes.
Good. Well, thank you. Final question to you all, which is going to have to be very rapid fire. And I'm going to ask you all in the order in which you first spoke. So starting off with Ashok and ending with Eric, is about the United States. There is a big election today, but the question is whether the United States and Europe in coming years, it may depend on the president, can work together to facilitate European Capital Markets Union in the interests of cross-border and cross-Atlantic capital flows, not just Europe, but this could actually help international capital markets. Ashok, a very general question. Can you give a relatively general answer to that, please?
Yeah, I'll confine myself to saying that we do strongly come down in favor of what we call maximum third country cooperation. We had Brexit in mind when we said it, but clearly regulatory cooperation cross borders is a win-win, we would say.
Thank you. Andrea, your reply?
We never stopped working very closely with the United States on capital markets development. We did it over the past 4 years, even before that, and I'm sure this will continue irrespective of who will be in the White House.
Your reply, Christian?
We could learn really a lot from the US, I think, in this sense. So I think we should remain open wherever is going to be there.
Sergio?
Yes, I think coordination and a multilateral approach, especially in an open market, is of the essence.
And Eric, the more loaded question to you is: will the US end up profiting from Capital Markets Union if it does lead to too much fragmentation and too much cost? Perhaps you'd like to frame your answer in the light of that thought too.
They're already benefiting, David. As an economist, you like free capital movements and a coordinated regime, as you talked about, but it's not a level playing field today. You are seeing very clearly American banks scooping up businesses in Europe that Europeans could have done, but because of the cost structure and the regulatory regimes, European banks are disadvantaged. Also, particularly because of the size of the balance sheets of American banks. So, but free competition, even playing field, 100% for it. I think it's a long way out, though. But.
Good. Well, I'd like to thank you all. We're coming up to the hour when I would hand over to Art after a 5-minute pause. So I'd like to thank everybody. It's been a virtual format, but I think it's also been quite conducive to good discussion. We do miss, though, seeing you in person, and we also, of course, miss the lavish hospitality of the De Nederlandsche Bank, where we would now be thinking of going off to a handsome lunch of ham and cheese, washed down with copious quantities of buttermilk, which is what makes the Dutch the people that they are. So we do miss that, and I'd like very much to think that we can do this next year as times start to get better. But I think we've done very well in going through the whys of Capital Markets Union. Klaas, who started off, did that very well, but you've all done that. You've used lots of analogies from building blocks to trains to mosaics and so on. I think we all know about why we need it. I'm a bit more insecure about the how, and the when is still a big stumbling block, if I could use another analogy there. But I think we're all also wanting the politicians to step up to the plate a bit more, maybe make the debate more simplistic, maybe allow the parliamentarians to understand what this is all about. It's difficult at a time when there's so many other demands on people's time. So thank you all very much indeed. Many of you, if possible, please do stay on for the next panel, which will be starting in about 5 minutes with Art Hulpen, who will be introducing Philipp Hildebrand. Thank you very much, and I look forward to meeting you all again, both virtually and in real life. Thank you very much for this excellent panel, all of you. All the best. Goodbye for now.
Thank you. Goodbye.
Thank you. Bye-bye.
Goodbye.
Okay, good morning, Fabrice. Good morning, Ayla. Good morning, Verena. A very, very good morning. Let's just check whether the microphones work. Can I start with you, Fabrice? Does your microphone work?
Good morning, everyone.
We have you there loud and clear. Wonderful. Verena, can I hear your microphone, please?
Good morning, Art. Good morning, everyone.
Excellent. Absolutely excellent. Ayla.
Hello. Good morning to everybody.
Good. Excellent. Thomas.
Good morning.
Good. And finally, Philip. Very happy to have you here, Philip.
Great to see you. Good morning. I hope you can hear me.
Yes, we can hear you loud and clear. So that's we're all set. That's operational risk has been reduced to minimum. So we're all set. So let me just wait one more minute, and then we'll push the boat out with Philipp as first speaker. Okay, welcome back to all participants. Ellie, is it okay to start off?
Yes, thank you.
Excellent. So let me extend a very warm welcome to all participants, all people watching this virtually. We would have loved to welcome you to a very sunny morning in Amsterdam, but you have a rain check for that for the future. We will now move to the second part of today's seminar, which will focus a little bit more shifting from the why question to the how question, and we're absolutely thrilled to have as our first speaker Philipp Hildebrand. Philipp is he's vice chairman of BlackRock, but he's a very close family of the central banking community. So it gives me very great welcome to extend a very great welcome to you, Philipp. Good to see you. My name is Art Huben. I am Director of Financial Markets at the Dutch Central Bank. And we will now have a keynote speech by Philipp, after which we will have a short questions and answers session, if that is okay with you, Philipp. And then we will move to a panel. So without further ado, Philipp, welcome. Please share your thoughts with us on the Capital Markets Union in Europe.
Thank you very much, and good morning, Art. Good morning, Klaas, and good morning, everyone. I wish I could be with you in Amsterdam, but look forward to our next visit. Building deeper, better connected capital markets in Europe is an important objective to promote stronger and more inclusive growth in the EU and to increase the resilience of the euro area against potential adverse shocks. COVID-19 has shown the importance of continuing to deepen integration. With an unprecedented public health shock in March, the EU overcame political differences to muster an effective response, which now needs to be fully implemented. Europe can unlock significant potential for stronger growth, higher productivity, and greater social cohesion by persevering on European integration and completing the single market. Completing Europe's banking and capital market union could unlock tremendous potential and reduce the reliance of foreign capital to fund innovation. Deeper and more integrated markets would increase Europe's ability to absorb and diversify risk. Completing the banking and capital markets union will not only unlock growth, innovation, and productivity growth, but also increase Europe's resilience in the face of the next set of challenges as the European economy ultimately begins its recovery. Although the ECB successfully stepped in and provided the necessary liquidity, it is paramount that we keep working towards the goal of a true single market for capital in Europe. CMU will not only provide a growing supply of capital for European companies, but it also advances key political objectives of the European Union. To be a bit more specific, CMU complements and reinforces the banking union. CMU strengthens and helps to safeguard economic and monetary union. And importantly, CMU fosters the EU's ambitious sustainability goals. Furthermore, CMU is the key to European savers realizing their long-term financial objectives via a wider set of investment opportunities. Over the last few years, Capital Markets Union has progressed in a number of key areas. Having said all that, important challenges still remain, and some of the remaining barriers might be difficult to break down, both technically and politically. Compared to the US, Europe still has underdeveloped capital markets. As a result, an excessive focus on cash, saving accounts, and bonds are exacerbating the problems posed by the decline in the equilibrium interest rate level. In addition, a structurally weak banking system continues to be held back by what is still an incomplete banking union. So what are the ramifications of these restrictions to a fully fledged CMU? Well, for starters, it limits Europe's ability to fund promising entrepreneurs and technological innovation in the European Union. These limitations in turn have in the past led to a brain drain of our most talented people and of our most innovative startup companies who felt compelled to emigrate to the US, where they could access capital markets more readily. Secondly, diversification of risks remains more limited in Europe. The lack of meaningful cross-border equity investments reduces the degree of private sector risk sharing between countries and leaves Europe more vulnerable in future crises. Klaas and I, together with so many others, learned this lesson the hard way during the financial crisis. The difficulty of savers to access the capital market in an efficient way results in insufficient long-term returns on investment and prevents the broader public from participating in the economic upside of the European Union. This is particularly problematic in an aging society with far too great a reliance on cash savings and government bonds. The lack of investment returns can ultimately contribute to feeding anxieties, voter discontent, and particularly worryingly, a backlash against the ECB in countries such as Germany. To me, the completion of the Capital Markets Union relates to the fundamental question of how Europe sees itself evolving over the coming decades. This question has, of course, become even more critical as we all observe the United States pivot away from its traditional role as a benevolent anchor for free markets in the post-war era. In financial markets, CMU will be an important step in the long-term strategy for European sovereignty in an increasingly fragmented global setting. I use the term sovereignty deliberately here. In light of the surge in geopolitical tensions between the US and China, alongside the challenges brought by the pandemic, it is clear to me that Europe needs to rebuild its sovereignty. Europe already has a large scalable market for goods and for many services. This, of course, is the traditional story of European integration that started with the creation of the single market in the mid-1980s. If we add the urgent objective of European banks to be able to operate at scale in Europe through a well-functioning banking union, this will help to create deeper capital markets. Today, all European banks are subject to the same regulation. 118 large banks are supervised by a single entity, the single supervisory mechanism. At the same time, a common resolution framework and the single resolution fund were established. But despite that, banks continue to operate overwhelmingly on a national basis, in particular for retail credit markets. This is not just a technical matter. Because the banking union is not yet completed, the euro area banking sector cannot act as a risk-sharing mechanism across borders. The deepening of the capital markets should provide a fertile territory for funding innovations which ultimately raise productivity and potential growth. If we manage to create synergies with our world-class science and technology education centers in Europe, we should see stronger growth long-term. If we also create a market structure that allows young people to become part of an equity culture and participate in the upside of these innovations, this would also help to alleviate insufficient retirement savings. This is no time to procrastinate. To deliver on this vision, Europe needs to wake up. Great power confrontation and rising fragmentation are the reality of today's global system. It is therefore high time that we develop our own sovereign European identity along the principal dimensions of physical, digital, and financial infrastructure security, alongside an efficient and scalable banking and capital market ecosystem that supports innovation, growth, and wealth creation. The importance of CMU for the ability of European citizens to participate more fully in future prosperity cannot be stressed enough. The first aim should be to increase retail investor participation throughout the Union. The second objective would be to create a more investor-friendly capital markets architecture that allows European investors, both asset owners and asset managers acting as their fiduciary, to benefit from the full scale of European and global capital markets. Third, we need better capital raising options across Europe so that companies have access to funding, especially at an early stage for their life cycle. Developing deep and robust capital markets in Europe will require significant retail investor participation. Retail investor participation is held back currently by two things: access to investing, as well as the perception thereof. As more and more banks are transforming their digital offering, access to investing will improve. Indeed, COVID-19 has only accelerated this trend. A recent study by Deloitte Switzerland showed that more than 70% of people who used online services to manage their investments for the first time during COVID are happy to continue doing so even when normal banking operations eventually resume. Although this is by no means representative, it is nevertheless an indicator of a change in behavioral patterns, which further incentivizes banks to bring the entire spectrum of their services online. Changing the perception of investing is, of course, a much slower process. There is still a significant reliance on cash savings across Europe. Cash and deposits and bank deposits amount to 30% of total EU 28 household assets, compared to 12% in the US. European investors would benefit from diversifying their savings among different asset classes. Simply consider the following example. If in 2007, so before the financial crisis, you had invested, say, 1,000 euros into a 60-40 portfolio of German equities and German government bonds, you would today have about 1,660 euros. If you had left the same amount in a savings deposit, instead, you would have 1,150 euros. 50 percentage point difference, for instance, that a German citizen would have lost out on. While the low interest rate environment pressures long-term savings in Europe, US households had broader exposure to the wealth generating effect of unconventional monetary policy. In short, European savers will need to become investors. More savings need to be turned into productive investment. The provision of capital must be mutually beneficial for both the investor and the issuer. CMU should aim to relieve any potential frictions observed in how capital gets allocated efficiently from market to companies, especially non-listed ones. Improvements to the structure of investment vehicles that help asset owners provide capital to companies in different stages of growth more efficiently would help grow the investor base. In this context, reimagining the funding escalator and also re-optimizing the LTIF, the European Long-Term Investment Fund structure, and tax framework for investors to better deploy capital in Europe, especially for non-listed companies in the early stages of a corporate life cycle, is crucial. Capital availability is also of crucial importance when we think about the challenges that lie ahead of us in funding the carbon transition. If we compare the stock market performance in the US and in Europe over the last 25 years at face value, we see, of course, and Anglo-Saxon media constantly refer to this, a material outperformance of US equities. However, Once you strip out the tech sector, the performance on both sides of the Atlantic actually looks very similar. So we can attribute the outperformance of the US to Europe having completely missed out on the tech rally. The absence today of a significant tech industry in Europe has far-reaching repercussions. SAP really is the only major European tech company we have. These repercussions are important for long-term growth, but also for the dependence on other nations to provide key technologies. If the sustainability innovation, for instance, carbon capture and other technologies to reduce the carbon footprint of economic activities, could be championed by Europe over the next 25 years, we could see the tables turning and Europe win this race for technological innovation this time around. However, we need capital to finance sustainable innovation. Meeting these goals requires major investments that help to transition European corporates towards a carbon neutral economic structure. The mobilization of private capital here will be key. Creating deep pools of stable private capital to support long-term investments is key to financing the transition to a low carbon economy. In view of the European Union sustainability goals, this reorientation of capital raising is urgently needed. The EU Sustainable Action Plan focuses heavily on enabling retail investors to deploy their capital in support of sustainable investment objectives. A key foundation of this is the development of an EU taxonomy to support the identification of investments that support those objectives. The proposed taxonomy focuses on identifying very specific economic activities as sustainable. In addition, CMU would optimize the capital markets architecture by addressing market fragmentation and by underpinning central clearing. The capital market ecosystem relies on a combination of market infrastructure, market practices, and legal systems. A key aim of the CMU has been to improve the functioning and efficiency of this market architecture within the EU, while strengthening cross-border integration and interconnection among Europe's capital market infrastructures. The recent market volatility further highlighted the need for a pan-European consolidated tape to drive price transparency and aid better investor decision-making. The need for a capital market infrastructure ties in with the need to create an independent European payment system to become less reliant on SWIFT and, as a result, free from potential extraterritorial measures. Let me put these specifics from the perspective of asset owners and asset managers into the broader economic context. Fundamentally, a functioning capital markets union is essential for an efficient allocation of physical capital in the euro area. The reduction of non-performing loans as part of completing the banking union, the key counterpart of the capital markets union, is not only relevant for financial stability, but also in terms of resource allocation. We saw in 2012 that countries with more flexible labor markets and a more effective insolvency regime navigated the crisis better and recovered faster afterwards. In the absence of the exchange rate as a shock absorber, other channels, notably prices, wages, need to facilitate the adjustment in relative prices within the EMU. Therefore, flexible, contestable, and integrated markets for goods, services, capital, and workers are even more crucial within a monetary union than they are for countries that have their own currency. The sustainability of EMU requires further reforms to complete the institutional architecture of the monetary union and to enhance the union's resilience to downturns. A banking union, including risk reduction and risk sharing, and a fiscal stabilization facility will help to absorb country-specific economic shocks. A considerable buffer against asymmetric shocks or an asymmetric reaction to common shocks would also come from creating a genuine capital markets union. In my view, financial market integration is at the heart of an efficient capital allocation mechanism. A functioning monetary union requires some cross-border risk sharing, private and public. In the euro area, risk sharing remains relatively limited, though. The degree of risk sharing I here define this as the share of GDP shocks that are all smoothed through cross-border channels is much lower in Europe than in the United States, than in Canada, or indeed in Germany. Not just for risk sharing through a centralized fiscal mechanism, which the euro area does not have, but also through private sector cross-border investments. What's more, private risk sharing channels seem to have weakened in the wake of the euro crisis as European banks refocused on their activities on their domestic markets. In addition, cross-border risk sharing mainly takes place through the debt channel instead of equities. Deeper capital market integration and a reduced tax privilege for debt financing could therefore allow more cross-border risk sharing, reducing the need for fiscal transfer mechanisms. Apart from investment regulations that need to be further harmonized, securitization rules, institutional and retail investment, progress on aligning insolvency regimes is key to remove barriers to cross-border financial activity. Brexit, which will likely cause financial activities currently concentrated in London to become scattered across the continent, gives rise to another rationale for further converging supervisory regimes. Ideally, equity financing should be placed on the same footing as debt financing in terms of tax treatment. To conclude, policymakers need to create the needed long-term framework to complete the economic and monetary union in order to ensure the continued success of the euro and the European Union. In my mind, and I will close with this, there can be no mistaking the importance of a capital markets union to improve European prosperity and to increase economic and financial resilience. Thank you very much.
Thank you very much, Philip, for this very powerful speech. You've strongly made the case from the investor perspective on the need for the capital markets union, sharing risks more broadly, having a better EMU, a better banking union, reaping higher returns. In short, reinvigorating the capital markets union initiatives in Europe. We now have the question for questions from the audience. We have about 10 minutes, if that's okay, Philip, before we move to the panel. What I think Philip has done is very complementary to the initial speech by Governor Knot, that Philip has shifted a bit more from the why to the what. So what do we need to do? We need to increase retail investor participation. We need to increase capital raising options. We need to increase systemic resilience within continental Europe. Can I ask you, Philip, moving a little bit towards the how would you see policies, private investors making this shift, stimulating the shift to a more retail investor participation? So how do we increase retail investor participation by European households?
Yeah, very good question, Art. I think the most important thing is for policy to signal that the journey towards banking union and capital markets union, the two things are closely related here in your question, is there. It's there as a reality. It may take a bit more time, but you have to remove doubts about where this journey is going to go. It is very difficult if you put yourself in the shoes of a CEO or a board of a major bank, it's very difficult to plan for, let's say, cross-border consolidation, for an M&A attempt, if you can't really be sure that the foundations of banking union and of ultimately capital markets union are there to stay. So I refer to this elsewhere as it's a chicken and egg problem. You know, the journey needs to be clear so the private market participants can initiate the strategies, if you like, that ultimately will allow private capital to mobilize and savers to react. And I feel right now we're in a bit of a halfway house where the commitment to the union is restated permanently or perpetually. As David mentioned earlier on this call, certainly COVID has accelerated the willingness towards further integration, particularly by Germany. Thanks to the leadership of President Macron and Chancellor Merkel, we've seen a big step forward. But it needs to become unquestionably true that we are headed towards a banking union and capital markets union, and that will allow banks gradually or other financial institutions to plan for that. I think that's the key. This is going to take a long time, but ultimately, it seems to me, and I take the case of the Netherlands, you know, this is a country that there is no reason why one or perhaps several Dutch banks 10 years from now shouldn't be major players at scale across the European Union with a profitable, scaled up business model. It will require investments. It will require growth. Banks are weak at the moment, so it's hard to think about cross-border activities. But I think the biggest impediment remains a lingering degree of uncertainty as to where strategically this journey is going to go. So public policy is absolutely essential to set the incentives, to set the guardrails that then allows private capital mobilization to occur.
Thank you, Philip. Perhaps I have two questions that go a bit deeper now. The first is, how can CMU be an effective instrument to boost finance to small and medium-sized enterprises? So how can SMEs have greater access to large investors in Europe? And the second, very related to that, is a question by Derek Keizer de Stockalper. And he asks, could novel EU Green Deal related asset classes become a catalyst to drive the emergence of an integrated CMU in Europe? So the Green Deal and SMEs.
Yeah, let me take the first question first. We have tremendous intellectual capital in Europe. I have no doubt that when you look at our universities, our research institutes, you know, we are not lagging the United States in innovation and young people who are at the forefront of research, particularly in the sciences or in engineering and technology. We also have, typically, when you have small startup companies, we have a pretty well functioning sort of initial capital raising ability through wealthy families, through friends and family. And very often what I observe here is when you have these entrepreneurs who start small SMEs, they do okay at the very beginning. They can get the initial funding to kind of get off the ground. But as soon as it becomes a matter of scaling the business, where you need not just more capital, but you need the entire kind of broad expertise around capital markets to assist these companies in the process of going from founding companies to growth companies, ultimately to dominating large companies like the ones we know in the US. That's when it gets very difficult. And over again, what I've observed as a practitioner is it is at that stage that they turn to the US capital markets, they turn to the private equity markets, they turn to the growth equity markets. And once you're in those markets in the US, it is a first step, and very often it leads then to the companies actually relocating and ultimately becoming, in this case, US companies in the tech sector. So I think it's, you know, it is that middle segment where you turn from a startup to a growth company and ultimately to a public company where the capital markets are failing in Europe. And if we can develop that, I'm convinced that we could keep so much more talent, so much more innovation, and we could get to a place decades from now where we would have leading, large, globally leading companies. I think the Green Deal is an enormous opportunity for Europe, and I'll be very brief why. I mentioned this in my speech. If you look at the reality, we have lost the tech race. I think we need to be honest about that, brutally honest. And frankly, it is hard for me to imagine in the digital space how we can somehow make up for that in the years to come. However, and I gave you the statistics, you know, broadly speaking, if you strip the tech sector out, Europe has not underperformed in equity markets. So to me, we have an enormous opportunity. Europeans care about climate change. Politicians care about climate change. We have a very ambitious set of policies that have now been embraced that are out there to incentivize. If we can use this momentum and use our scientific innovative capabilities and find a way to tap capital, European capital, to help fund this process, I think there's a real opportunity that, you know, a generation, 2 generations from now, we can have leading companies in the climate change sector, in the whether it's carbon capture or new sources of energy that operate free of fossil fuel. I think this is enormous opportunity. I do want to remind you, I have to always remind myself, people talk about this great private sector in the US, but at the very origin of Silicon Valley, frankly, there were very clear public money initiatives to start this whole process of innovation. And this is exactly what the Green Deal can be. I think the Recovery Fund has potential to play into the same dynamic, where we see this public money engine, in a sense, that triggers innovation, triggers funding of European innovation that ultimately could lead, in an optimistic scenario, to globally leading companies in the space of sustainable energy 20, 30, 40 years from now.
Philip, thank you very much. We have a bunch of other questions, but we're going to save those for another day. Thank you very much. You've really given us a pretty powerful arguments on why and what we should be doing. So thanks for that. And please, can I invite you to keep us sharp? You're very close to our community, so stay engaged and keep prodding us in the direction, because I think most of us here today really share all your convictions on the why and the what. So thank you.
Good luck. Thank you very much.
Thank you, Philip. Thank you very much. And Philip has very nicely set the stage for the second panel. And I would now like to invite all the different panelists to join the virtual debating room. And if Ellie could invite them while Eddie is tagging them all on, let me introduce them to you. We are very happy to have an extremely qualified and diverse, also much more gender mixed panel than the first one. We have 5 participants. Fabrice de Marigny will be the first speaker. He is chair of the Next CMU high-level group, global head of capital markets activities at Mazars Group. Then Ayla Cravey, director and head of capital markets at the European Investment Bank. Then we have Leonieke van Houwelingen. She's chief executive officer of BN Bank of New York Mellon in Brussels, the European Bank. Verena Ross, the executive director at the European Securities and Markets Authority, ESMA. And finally, Thomas Wieser, the chair of the CMU high-level forum at the European Commission. So we're extremely happy to have these 5 panelists. I hope they are all here. I can only see 4 of them, so I hope Leonieke will join us also. Let me start by prodding you that we are now especially looking for the how and the when and by whom questions, so to get the progress as specific as possible, as accountable as possible. And let me just remind you of one statistic fact, which has been in broad terms, a lot of speakers today have already referred to the fact that capital markets financing has increased as a share of total finance in Europe after the great financial crisis. And indeed, from 2008 to 2015, you saw an increasing share of capital market finance in total finance, But since 2015, it's more or less stagnated. So it's been horizontal as a share of total financing. And the irony is that 2015 was also the year in which the Capital Markets Union initiative was launched. So one would have expected the share to increase, but it stagnated. So I'd really invite you to stimulate us on the how do we increase this share. What we the organization of the panel will be as follows. Each panelist will be asked to provide an introduction of 3 to 5 minutes. Then we will have a questions and answers from all participants, and please feel free to ask your questions in the chat. And the panelists will then also be offered an opportunity to react to each other if they so desire. And right at the end, which will be around 12:35, I'd like to wrap up by asking each panelist to give 1 minute or perhaps 2 minutes, but a very short, succinct, focused message on what needs to be done. So on the how, on the what, by whom, and by when question. So without further ado, can I invite you, Fabrice, to push the boat out?
Well, thank you very much, and good morning, everyone. Thank you very much for the invitation, and a special hello to Thomas, because I love to share with him a lot of CMU ideas, but I have to say that I hate to share with him the sadness that comes with terrorist attacks. So I have very specific thoughts for Austrian people and Thomas in particular. But let's move to the various questions: how, what, when. I would try to explain what is my fundamental thoughts, having worked on this and read a number of reports, including the ones from the Parliament, the action plan, and the discussion this morning. I would say that mainly on the how and the priorities, I would recommend to do 3 things. The first thing is really to regroup the various initiatives, because the CMU action plan is an interesting list, but it works closely and quite synergetically with the digital finance action plan, the sustainable finance plan that is due to come in December, and the international role of the euro. This was said by Andrea, and I very much share that. And it's a unique opportunity because now for a long period of time, we have now a dedicated commissioner to financial services, which brings a real opportunity to put together all these things and to create the synergies that we need. So first, to regroup and to put that under one umbrella, which you could give a specific name to that umbrella. This is what we recommended to do. The Parliament is echoing that request to attract political momentum from policymakers, but also from citizens, for them to understand why this is needed. So we recommended to call it the Saving and Sustainable Investment Plan, which very much which regroups all these objectives. But the second recommendation would be really to set objectives, because in this myriad of initiatives or building blocks, call it as you wish, what is missing is the intermediate objectives we want to achieve, not only legislative ones, but in the market. What do we want to see? And I would recommend 4 of them. The first one is indeed to generate more long-term savings. It was said several times. I don't need to explain why, it was clearly said. The question is how and what to do. I think to request member states to have multi-pillar retirement saving plans on which they will be accountable, exploring auto-enrollment solutions would be very good. Facilitate workplace savings or employees sharing plans, share plans to have more long-term savings is very important. turn savers into investors, that was mentioned several times, and this is really in the hands of member states and the industry, and also to have a measurable and comparable sustainable investments, meaning not only the taxonomy, which is the investor viewpoint, but also on the issuer's viewpoint, non-financial standards, for which Europe has made a lot of work and is in advance. Second objective is to have strong equity markets to relocate industries of strategic importance. We will need capital and share capital. And we mentioned LTIFs, of course, organization, that is the Commission to do, but late equity, private equity funds, this is really the industry to do, to simplify access of SMEs to markets, this is the EU to unholding of equity, and for that you need to review Solvency II and IFRS 9, so that's really in the hands of the Commission. The third objective is to have more integrated and trustful markets, meaning to favor mergers of market players. This is in the hands of member states. To avoid supervisory competition, this is really in the hands of member states and supervisors. And also to restore trust. We are in a post-Wirecard environment, and there is a need to fix the payment system supervision to ensure that governance rules and listing rules are really applied and make auditors' work quality unquestionable by, for example, introducing joint audits. And fourth objective would be to have a more dynamic debt market, and that would favor the international role of the euro, or more products in the market. One of them is securitization, has the objective also to alleviate balance sheet of banks and therefore favor the recovery plan. So that would be the way of creating objectives. And why to create objectives, that's my last comment, is really to monitor the progress and to keep the momentum about this initiative and the financing of Europe economies through the markets, and creating KPIs. Of course, we need to follow if legislative processes are progressing, and the Commission does it very well. But let's try to build KPIs where we can measure progress and set up a steering monitoring committee as you wish, where institutions will be there, pilots by the Commission, some may be external experts that have the possibility to measure progress over the years and help unlocking difficult files for whatever political or practical reason, but to keep the momentum and not to go into very technical discussions, disperse on the 25 legislative discussions and no one really knowing why he is doing this or not. So that would be, in short, my recommendation.
Thank you very much, Fabrice. So regroup initiatives, set objectives, set KPIs for intermediate objectives, make it accountable and monitorable and transparent. Ayla, can I ask you to add to this from your perspective from the European Investment Bank?
Thank you. Yes. I also have to say that, well, I'm from EIB, which is an EU institution and also a public sector bank. But I work in the capital market side of EIB, and hence my comments are a bit aligned. I have also the market perspective, debt market perspective in particular, in what I'm going to say. So I think that there's sort of two main areas that I want to touch very briefly. And I think it's very easy to agree with everything that Fabrice said just before. The sustainable finance angle, which has been taken into account, and it is there in the action plan. I just want to underline it, that this needs to be really a one of the building blocks of the capital markets. You know, there's no point in building something where this is not inherent part of the picture. And right now, of course, we have lots of standards and definitions and work being done in this area. I think initially a lot of this will concern large corporates and large banks, and whereas CMU also targets financing of SMEs. So one has to bring the two together, because SMEs are not right now in the main focus of the sustainable finance plans. So these two need to be connected. And for example, banks, if they want to be able to report what is asked from them in the sustainable finance, they will have to know what's in their SMEs that they are financing as well. So the two are inherently linked, and that has to be kept in mind. The other thing about SMEs and their access to finance, both debt and equity and bank financing and non-bank financing, of course, emphasis in the CMU is on the latter. So on the equity side, I think it was 6 months ago, maybe in the spring, the Commission's President von der Leyen, she made this proposal or mentioned idea that maybe one should create an IP, initial public offering fund, which is really a public-private joint effort, helping SMEs first-time listings, and that's obviously one thing that does not quite exist yet. I'll mention our activity in the SME field a bit separately. We are looking into that with stakeholders, whether that could work and how it could work. But I think it's, for example, and simple things, when we think about IPOs, we also have to think about how do you do this, your listing prospectuses. Now the new prospectus regulation is a lot better than its predecessor. We know it from the experience that the previous one was quite tough. The new one is better already because it's directly member state legislation, and you cannot gold plate it, which I think sometimes this gold plating has also the protectionist intention, not only protecting your investors. So that's already a big improvement. But we still have practical problems. I mean, we still have 27 member states in the EU and almost as many languages. And in many of the cases, you still have to provide information to investors in the local languages. And that is a problem. It's a very understandable barrier, but it is a barrier nevertheless. And somehow one has to keep this in mind when one is hoping for a united market for SME equity. Now, SME access to debt per se, I think it's bank financing will always be a big part of SME's life. That cannot be avoided. But also the bank's financing to SMEs can be made more efficient through more efficient securitization, because this is how the banks can alleviate their capital needs. ECB has been indirectly supporting the development of synthetic securitization, and I think that has to go further and that has to grow. And for example, EIB Group has been a big investor and guarantor of the products for more than 100 million euros worth of transactions. So we have two products there. The bank itself acts as an investor in this securitization, whereas European Investment Fund, our subsidiary, acts as a guarantor, and both are very popular products. For example, the EIF, who is particularly an SME vehicle within the EIB Group, is a very popular one nowadays. So the external mandates that we get from shareholders, from the Commission, they are all very focused on what EIF does. And for example, the European Guarantee Fund, that is our main initiative with the pandemic crisis, is very much geared towards EIF activity as well. So public and private is here already in the same picture, and I think we still need to keep it there and going forward. But I think one sort of two overall remarks, which are quite obvious but still need to be mentioned, I think, is that we have quite a few different regulations which are already out there, which are in the making, for the capital markets, for sustainable finance, for prospectuses, for the secondary market, for reporting, etc., etc. We should just pay attention that we are not making too many things which then at the end do not work with each other. So all of these regulations will have to be working together, and they should not impede the functioning of the market themselves. And one should also keep in mind that, for example, debt and equity markets have very different mechanisms. What is drafted or what is put in place with the thought of one market does not necessarily work for the other, and can even be counterproductive. So I think the two principles that we have in sustainable finance, that you need to make a substantial beneficial contribution somewhere, at the same time do no significant harm elsewhere, should also be applicable on capital markets union. Do substantial good, but do not do significant harm elsewhere. And one other thing, when we have been talking about how to include the retail investors and quasi-retail and all that, the SMEs access to equity and how these two can be linked together, I think we still have to keep in mind that even at the level of private investors, retail investors, we have to accept the principle that public sector cannot protect them forever from any losses. The investing in equity and investing in SMEs, it bears some risk somewhere. And the idea can't be that the public sector alone will bear this risk. At the same time, we have to see that people do invest in instruments and at the level of risk which is appropriate for them. Small town teacher maybe has a different risk profile than a millionaire or a big investment or an insurance company. So I would also underline the importance of financial knowledge and literacy and capacity building in that sense. It is crucial if we want to get retail investors engaged in this market in the longer term. Thanks.
Thank you very much, Ayla. A very broad-ranging further perspective on the public sector principles and the need for focus. And I think it's high time to include the private sector perspective. So I'm really thrilled to be able to invite Leoniek van Houwelingen to the floor. Leoniek, can I give you this virtual domain to share your thoughts on how we get the private sector in movement?
So thank you for giving me the opportunity to share my thoughts and to contribute from a private sector indeed. And I think I would like to start by saying that I'm extremely excited about the fact that the European Union put this on the agenda and on the agenda again, even though I know there's been a lot of discussions ongoing, and we come across similar hurdles. However, having been part and invited to the high-level forum on capital markets union, I've been very close to the discussions and the recommendations that ultimately were presented by the European Commission. It is a super important project, and it's a topic. And indeed, it's not new, but a new attempt, I would say, to get this across the line. And to look around and see so much support, you almost wonder, being, a businesswoman, why we can't get this done today. Well, it takes time, and I fully understand. But basically, how I look at it is that we're dealing with two related problems. One is the small size of the EU capital markets, and it's secondly very segmented national capital markets with their own rules, making it very hard to access markets. But there is a huge potential of capital markets to help challenges like we just discussed, COVID-19, growth, ensure growth and wealth within the EU, the long-term investment capabilities, ensure competitiveness, which is extremely important, and the green agenda. If you look at a third country investor or issuer, today you look at a market that's super fragmented. You look at 27 states with their own laws and their own specificities. If you compare that to the US, where there are also 50 states, they at least, have their particularities, have their specificities, but one thing they do have in common, and that is common securities law. So, I recommend very much focus on that standardization and creating simplicity and transparency. Looking at the key recommendation, to me, it is a package. And as capital markets are an ecosystem, so there are a lot of things that need to be connected, and you can't see them separate from each other. And I know I'm listening also to the introduction as Knut, focusing on priorities, fully understood, but I strongly believe that all 17 recommendations need to be taken into account and should not be seen as separate. If you have to argue, I would say, what are the game changers? And we looked at a number of game changers in the high-level forum. I think the recommendations from a perspective on LTIFs, the pension funds, securitizations are very, very important. So Those could be game changers, even though on securitization, this is more a revival of necessary investment means post-crisis, moving some risk of the balance sheets of banks. But, you know, there is a bit of a dry market, and there is willingness to invest. LTIFs, something like seen as a vehicle for retail investors to invest in long-term, less liquid assets. We talked, and I know that Philip made a reference as well to the means funding for SMEs, etc. Is really a good means of funding in a more secure environment. Pensions, extremely important, because the pensions gap is increasing. We see the rate of old age poverty rising. So initiatives about pension auto enrollment in very important proposals. And I come very close to what is very close to my heart, and where we've contributed a lot is the functioning of the markets. And we are very, very strong, how do you say, supporters of focusing on the definition of shareholder, on withholding tax. And also, Klaas, those are priorities too, but they're very complex. They're very complex, and I fully get that. But there is, and if you focus on the process and not on the tax laws itself, but if you focus on a process to make that more transparent and really come to some sort of common standardization on withholding taxes, for example, that will increase the accessibility for retail investors dramatically. And it is something that can be achieved. And we know that there are private sector initiatives ongoing, for example, on further digitization that will help the markets to overcome these hurdles. We know that SRD2 is upcoming, and it's, you know, one of the actions is only on shareholder definition is only up for 2023 because people want to first comments are SRD2. However, the law does not provide for a definition of shareholder and leave it to the countries, which means that 27 countries will have to ask themselves the question on does the law provide end investors with a full entitlement to their investment? Does the law enable the identification of the end investor, the beneficial owner? In some instances, we know the answer is no. In some instances, we know the answer is yes, but there's also a but. So 27, which makes it very intransparent and basically also creates the perception to the investors that it's difficult to invest. So shareholder definition, withholding taxes, very important fundamental issues to focus on in a very near term. Technology is the one that needs to be the driver for changes. To give you just a hint, because we're very close to this market, on withholding taxes, for example, the Netherlands is one out of the 2-3 countries that allows e-filing. So all the other countries are still paperwork, need a lot of intense, very costly manual processes to reclaim taxes. So just those are very practicable examples on what needs to be addressed. So next step is the report is addressed to the European Commission. So we hope that the Commission will include, and we've seen the recommendation, but also will be able to execute on it. And we'll do that within its term, because it's of course 5 years. And it's not simply the work of institutions. Many others, and I know from the private sector as well, are important, authorities in countries, the states are super important, but let the private sector help in finding the solutions. And I just refer to, for example, the initiatives about digitization on withholding taxes. It needs, I would say, a very close follow-up and publication of the efforts, and so that people can keep a view and an eye on this. And I'm hopeful that the supervisory debate does not overshadow the report. Hopefully, we will keep the momentum and accelerate initiatives. Thank you very much.
Thank you very much, Leonie. You have brought us certainly a step closer to the question of how, by whom and when, and in essence, the KPIs that Fabrice was calling on at the beginning, very concrete things, withholding tax procedures, making them transparent, and then converging and harmonizing them, shareholder definitions, publication of the efforts by the different authorities, etc., etc. But you also mentioned the common securities law, so there's enough food for to bridge over to the next person on the panel, Verena Ross of ESMA. I'm absolutely thrilled to give you the virtual floor.
Thank you very much, Art, and thank you. It's a great honor to be here today, and thank you for inviting me. And talking about CMU obviously is core to what we do at ESMA, and I'm particularly honored, I have to say, to be speaking about this topic, having both Fabrice and who has worked so hard on the next CMU group, and also Thomas, who has obviously chaired the high-level forum on the same panel, who have clearly looked at all these issues in great detail. I think from my perspective, and as has already been raised, there's a lot of consistency here between the different proposals and action plans and recommendations that have been put forward. And what is also clear is that what it is really about now is trying to give it another push and another new energy to make sure that we really progress in this area. And I think, as others have said, that is particularly important because we need to find diversified funding sources for the European companies and sovereigns in light of the economic problems that we've had. We, with Brexit, are losing a key wholesale financial market in London, and therefore it's important that Europe builds expertise, capacity, market infrastructure, and capital markets that can really support the European companies. And finally, and by no means least, another key driver from my perspective is the fact that investors are looking for return and sustainable investment opportunities in a long-term, low-interest environment. And saving for retirement is extremely important. And for that, it's clear there needs to be greater diversity. In terms of focusing on the actions, as you asked, let me focus on two main themes here from the European Commission's Capital Market Union Action Plan. One is around the area of SME and company access to transparent capital markets, and very much linked to that, but more on the demand on the supply side, is the rebuilding investor trust in capital markets, because ultimately any market needs the provider of the capital and the takers of the capital. So we need to really look at both aspects here, I believe. On the access of companies, and particularly SMEs, to transparent capital markets, the Commission Action Plan puts forward a number of areas, but I will just focus here on three briefly. One is the making companies more visible to cross-border investors, the so-called European single access point for company information. I think this is something which is really lacking in Europe at the moment. If you are an investor and you want to find out where there are companies that I can invest in, that information is very scattered. It's maybe brought together by some commercial companies, but actually formally and publicly having free access to information about financial information in a consistent way, and extending that also into more non-financial information around sustainability factors, for example, is absolutely key. And I think quick progress on that. It's not easy to build something like that, but I think we have some basis we can build on, and I think it's extremely important. The second point is the supporting especially SME access to public markets. There is already obviously the concept of the SME growth market, which has progressed better than many people I think have recognized. At the same time, there is still potential to build on, and where we also clearly need to have another look at getting the balance right between getting listing rules which are doable and manageable for smaller companies, but at the same time still provide information for investors in a way that ensures that they have the right information on accounting, prospectus, and other things. Linked to this, and maybe also building on what Philipp Hildebrand said, is also the need for proper information of where prices are in the market. So I think consolidated tape is a very important other proposal to be taken forward. it's particularly at this stage, I think, also trying to be realistic. Post-trade consolidated tape for equity and equity-like products, I think, should be the first priority here. But it's really providing also to the end investor a clear picture on what the prices are and whether actually they are getting best execution. Looking now at the investor side and rebuilding trust, I think there are a number of important proposals in all of the recommendations that were made and in the action plan as well, around looking again at the inducement regime. And clearly in the Netherlands, you have a particular approach to this, which is very different from the rest of most European countries. I think it's very interesting to look at what the banning of inducements across the board has meant for the Dutch investment market, for the Dutch investor, and learning from that. I think it's not easy to just extrapolate that to the rest of Europe, but at least looking carefully at what can we learn from these type of experiences, I think is important. Disclosures is another part that is very important, and providing investors with the right information, ensuring that they are properly supported where they want it through advisors that are properly trained and can help them, is also essential. And I think Isla's point on it's important that investors take risks, that's absolutely true, but they should take risks that they properly understand and that they are properly advised and supported in that process. And financial education is obviously another important aspect in terms of ensuring that investors know what they are doing, as well as pension systems that Leonique mentioned. So all of that, I think, needs to be supported by proper and proactive supervision and enforcement that ensures the right outcomes for firms and investors. And clearly, there's a big chunk of work ahead of us. So very happy to hear further words on this from the panel, and then get to questions as well. Thank you.
Thank you very much, Verena. Can I just ask one very short question before we let you off the hook? Who should provide and organize this single European access point for enterprise information you referred to? So who should we be calling to organize this?
So I think the high-level forum proposal was that there should be building on existing systems where companies provide some of that information already at national level. We should clearly avoid double reporting. At the same time, you need a European hub to bring it all together. And I think the high-level forum proposed it should be ESMA. And we would be happy to work on that and stand ready to do that. But I think it needs to build on common reporting standards. It needs to ensure that companies are pushed in the right direction to report similar things. And we would be happy to work with what is already existing at national level to try to provide that.
Thank you very much, Verena. We have our first KPI. So thank you. That's extremely useful. Thomas, can I very happily give you the floor to provide the final overview with your vast knowledge of Brussels and how things function. How do we get this moving? How do we reinvigorate the capital markets union in our countries and in Europe?
Thanks, Art. I would not disagree with anything that has been said so far, so it's very difficult to be additive. I'll make more or less 5 clusters of remarks. The first one is maybe on politics. And there's the Anglo-Saxon saying that Rome was not built on a day, but one wonders if there had been 27 member states and the co-legislator, if Rome would have been built in the year 2020 or still being set up. But one of the sort of intractables on the politics that strikes me again and again is the tension between the fact that a capital markets union has very much the attributes of a public good, but on the other hand, politics very often fails to recognize that and behaves as if there were 27 sets of national industrial policies. And that is, I think, at the heart of the tension that we are facing, and why it has been so very difficult to go through the slog of the details. And maybe the label Capital Markets Union has at times been a bit of a hindrance, because it's a nice catchphrase, and on Sundays you can always say, I'm all for the capital market or capital markets union, but you don't have to face the problems of dozens of different directives. Enough has been said if you say, I'm all for it, but you don't realize how much you need to work to get there. And we do have the problem that we've got two kinds of member states, with my apologies to the Netherlands. If I'm trying to sort of oversimplify, we've got two kinds of member states amongst the 27. There are those that have a small capital market and realize it, and there are those who think they don't have a small capital market. So that leads me to the second kind of remark. I'm excluding the Dutch here, of course, which leads me to the second set of remarks, which very much in our high-level forum report, we maybe glossed over a bit too much, namely how much of the responsibility lies with national policymakers. And so for them, it's maybe a bit made easy that they have the impression all of this is pushed to Brussels, and all we need is a good Commission draft directive, and then we will tell our experts to chew it and we'll come up with something. But in reality, if you look at issues of withholding tax mentioned already, financial education mentioned already, insolvency procedures mentioned, national pension systems at the heart of a future dynamic capital market, all of these things, they benefit from work in Brussels, they benefit from guidance, they benefit from coordination, but at the heart of everything is the tough mile you need to walk domestically, making pension systems more resilient by strengthening second and third pillars, by telling the tax experts not to be obstreperous, but to coordinate better with colleagues abroad, to have an insolvency administration that actually works in practice and not only on paper, etc., etc. And this is where I see a possible connection to what we've been discussing with the Rescue and Resilience Facility, the Next Generation EU. And there is this debate also within the Commission of whether this should be a macroeconomic budget support vehicle, or if it should be something which is more focused on individual policy targets contained in the so-called European semester. And if one were to link it, and that is very much up to Commission, Parliament, Member States, if one were to link it in a productive manner with some of the key performance indicators that Fabrice was rightly mentioning, then this would be a double win for recovery and for capital markets. So I see a very, very strong potential connection there, and I would hope that this is taken up. The third set of remarks pertains to harmonization of regulation. And Ayla has mentioned the problems of 27 different markets you have to deal with, and others have done so as well. So harmonizing, going through regulations and not directives is, of course, a very important point, which, however, brings one to the problem of national administrations, politicians, and legislators who would love to have a certain room of national discretion, which is, of course, counterproductive if you have the public good aspect of capital markets in mind. Fourthly, we should be working more on convergence of not only definitions but also of practices, which is a bit of a code word, I guess, for supervisory convergence over time, which is, I think, important, and where views in our high-level forum were quite diametrically opposed to each other. And at times I had the feeling, if you look at the Gauss curve of opinions, it was not really a Gauss curve, because 50% of the people were sitting on the left side, 50% were sitting on the right side, and I was sitting in the middle and trying to get somewhere. And the fifth point I would make picks up a bit on also some of the remarks that have been made with regard to access to public equity markets, data availability, etc. And I'm very gratified to have seen that this is one of the important points at the top of the list, which is being prepared for the December Council conclusions of finance ministers. But the issue of data, let's say, availability, visibility, then accessibility, marketability, scalability, and if you so want, exitability, are at the forefront of work that needs to be done there. And again, it is not without a strong national component. And if you just, in closing, think of the example of an innovative entrepreneur in the Slovak Republic looking for an investor. It's a very, even amongst our very small markets, it's a very, very small market. And so he or she may not be able to find an investor. So he or she may get on the bicycle and ride up the road to Vienna, which is, you can do in 2 hours of by bike. The market's not much, there are not many more investors there. So there's not much use in getting on your bike. So you might as well go to the airport, get onto a plane and fly to the US and try and find the funds there. You'll find the investor, you'll find the money, and you will find the potential for your innovative company. And if we can't sort of connect the national efforts and the European efforts, trying to explain better to politicians what needs to be done and what the difficulties are. And I strongly believe if we don't get the push from the very highest level, if we leave it to the experts in finance ministries, justice ministries, and other consumer protection ministries, then we will continue to stumble along at a fairly low pace. We need support, I think, from the highest political level, and we need the help of all the participants on this call today to better explain at the national level what the public good benefits for all of us are. Thanks very much, Art.
Thank you very much, Thomas. So we have in Europe countries that have a very small capital markets and countries that don't know they have a very small capital market. But those are the two sorts of countries we have. So there's a lot to be done, and I think these 5 presentations clearly illustrate that it's a mosaic, that we need to have a very multifaceted, multi-pronged efforts to move this forwards. I think what we'll be looking for now in the debate, and it's open for questions in the chat. I'll give you 2 or 3 in a minute, but we're looking in particular, that would be my first question to each of you, but okay, give us KPIs. So we've had one KPI, key performance indicator, for the establishment of a European level of access to enterprise information data, which was, I think I heard that come back, in fact, in each of your presentations on how important the data is. But that's one KPI. What other sharp KPIs would you have? I see here that Robert Patalano from the OECD is asking what 2 to 3 critical obstacles, and in essence, those are also KPIs, do you see, on the one hand, to develop a well-functioning, dynamic private equity market, and on the other hand, to integrate growth of private and public equity markets directed at green, sustainable finance investments? So that's one question. I have a question by Sharma from Accenture, and he asks, how will transparency in the Capital Markets Union will be kept with respect to tax and money laundering regulations that to some extent are still nationally supervised? So can you please give these two answers and the question on KPIs? Who can I give the floor? Who would like to react?
Maybe I can start. For us, clear KPIs are really about overcome the hurdles that we witness every single day, and that is a real, true, a very practicable outcome of some initiatives that need to be undertaken. That is really around the standardization on withholding taxes, so that needs to be a KPI. And I don't think there's any disagreement in our debate. I think we all were in fierce agreement that this needs to be addressed. I would still very much focus also on the definition of shareholder, and to maybe also link it to the question on AML. We know that the AML directive is implemented locally with all their specificities. I would say that is an unintended consequence maybe of a very well-intended law, that we do see again fragmentation. I would argue that in transparency on withholding taxes, for example, but also around shareholder definition and corporate action related to investments, that you will also be able to make it much more transparent with a good consequence that there's less how do you say that, possibility for fraud, because tax and fraud do go at time hand in hand, and we have such a complex organization around taxes that this will also be an opportunity. So thinking about fraud aim altogether, the markets will be well served a common taxonomy by a common around this, so in well-functioning markets where you need to take away the very obvious hurdles like the withholding tax, the SRD2 definition of shareholder, and insolvency laws is something that probably is a little slightly more complicated, but needs to be on that list as well.
Thank you very much, Leonie. We've noted all of those KPIs. Others?
If I may, maybe
Verena and then Fabrice. Verena.
So for me, a lot centers around, and if we go back to this data and information point, which I think was also in some of the questions there around transparency and critical obstacles to developing equity markets and so on, it's the comparability of data, the availability of data, and the quality of the data. And for me, comparability of data also speaks to making sure that there are common standards of what is reported and how it's reported, that there is, where we can, clear regulations that are common across Europe for that. Obviously, it then also gets down into quite technical detail of implementation, but that is something which we can't do without, and we need to create something that is also cross-cutting the different sectors, because otherwise you end up with one standard on the banking side, one on the insurance, one on funds and so on, which end up not being comparable. And then the other part of it is availability of that data. I just want to bring in here the MiFID review, which is also going on in parallel. If you look back at what MiFID II has actually achieved, you can see that in many areas, transparency, while it was supposed to increase, has actually decreased, or certainly not increased to the level that the co-legislators and the public, I think, has expected. And I think we really need to look at that again. It created a very complex system of exemptions, waivers, and so on, which has led in the end to less transparency than is needed in the market. Thank you.
Thank you very much. Fabrice.
Yes, on KPIs, to be very concrete, I would measure the amount of long-term savings and how it progresses over years. on several member states. I know in the Netherlands it goes without saying, but it's not the case in the rest of Europe. The number of IPOs on regulated markets, including SMEs, the number of late-stage private equity funds that manage more than 1 billion euros. We have maybe 2 currently on the continent. The number of mergers of market players, be it exchanges, platforms, post-trading platforms, banks, not only banks, that's what I'm meaning. Interesting was mentioned this morning, the length of insolvency proceedings across Europe. That could be an interesting KPI. The equity holding by insurance companies that has diminished with Solvency II, would that pick up again? And the number of securitization issuances. So very concrete, on the ground. Is it, because this idea of having legislation that is intellectually perfect, but it's not producing effects, it's something we should connect all the points and make sure that the reality on the ground is changing.
Thank you very much. Thomas.
That's funny. I was going to say more or less exactly the same thing as Fabrice, namely suggest to set up a scoreboard or a map of capital market depth, and over time look at potential capital market broadening and deepening in the 27 individual member states, measure progress by a number of parameters, and maybe hold that up to national politicians in order to provide more push for them to be more active domestically and behave in a less procrastinating manner at the European level. So that would be one sort of kind of scoreboard containing the individual key performance indicators, and I think the ones that Fabrice has mentioned are absolutely perfect. And I would also create a second second app with information that actually is available. And if you think back to the times when we were setting up banking union, the SSM was created and they started to map the sum of options and national discretions, and to their astonishment, they found out at a first trawl 120 ONDs, and those are of course huge obstacles to creating one functioning internal market for banking services. And in capital markets, the situation is even much more diverse. If you were to set up a concrete map of what in banking terminology would be options and national discretions, I'm afraid it would fill a book, but it would be a good idea to have it actually on paper to again hold it up. And that could of course include the very divergent national transpositions of EU directives, be it gold plating, be it through legitimized discretions contained already in secondary legislation. But what we've witnessed, and this has just been mentioned, what we've witnessed in the field of money laundering is not confined to that area, but it's pervasive. So if we can first map it in order to show what the issues are, what the responsibilities are, and use that as a push for more convergence, I think that would be a huge step up a long ladder.
Thank you very much, Thomas. We'll now go to a second round of questions, and then we'll wrap up at the end of this second round. So I'll ask you all to be brief, because I want to keep a minute for each of you to give your last closing call on what you think the real issue is that we need to address. But just in this round, I have two questions, one from Catherine Nijs of PGGM Pensions, and she asks that what she's heard a lot is are issues that are going to take decades. So a lot of the measures that have been mentioned are going to take decades. And is it realistic that given the long germination of these initiatives, that we can also expect support of near-term agendas, for instance, the green agenda and the digitalization? So is this really going to make an impact on the near term? My question would be, and I'll add to that, to Fabrice and Thomas, I think your idea of a scoreboard of capital market depth indicators is very interesting, but it's an intermediate indicator. And what you essentially want is you also want indicators that are, so you have the end objective, which are capital markets, then you have your intermediate indicators, but you want the operational indicators, the indicators of what actually has to be done. Because if you have these depth indicators that go in the wrong direction, so there's less retail investment in equity, less cross-border risk-taking, and such like, you want to be able to link that to something that someone has to do, so an operational lever. And my question would be to you, what are the key operational levers? What are the key operational steps that need to be taken? We've heard a number of very important ones: standardization of withholding taxes, shareholder definitions, common taxonomy, shortening insolvency procedures, and such like. If you can give any more of these, comparability and availability of data, but please provide some more of these in this last second round. Who can I give the floor? Thomas, you can start.
Well, if you look at the action plan of the Commission, I think they have very much taken on board what we were saying and what Fabrice and his group were saying, that this is that these capital market action plans, reports, etc., are not a restaurant menu with 20 different things on the menu, and you go in and you pick a main course and a pudding, then you go out and the rest you ignore. This is something where each and every element reinforces. There is a sense of mutual reinforcement, and therefore I would be loath to say there are three very important ones and let's forget the rest. And the conclusions that are being prepared for finance ministers reflect this, and they are, if you so want, the headlines for the respective key performance indicators. And what so far is possibly missing is, but that's contained in the Commission Action Plan, is the end date by which it should then be in force. But these are legalistic key performance indicators. What I think Fabrice and I were referring to is, how does the lack of political agreement on regulatory and administrative measures, how does that then impact on the development of individual capital markets and the European capital market? So I think if you are able to link these two, then you've got a quite powerful instrument to say this and this should have been done by Q2 in 2021. It has not happened. If we look over time how markets are developing, there is good reason to believe that your failure to agree on a better securitization framework has led to bank balance sheets not being assisted in offloading non-performing exposures, etc., etc., etc. So I think if you link these two concepts, you are there at a fairly holistic picture of who should be doing what by when, and it is dynamic over time as well. That's how I would see it.
Thank you, Thomas. I'm looking at the clock, and given the clock, I'm going to ask you to fold in your closing comments with your reactions maybe to these last two questions. Thomas, if you have anything else to share, please do that now, because I'm now going to go through the whole list of speakers in the reverse order of the introductions. You were the last speaker, so I'll ask you as first, do you have something to add? You just said we need a holistic approach in which we link these intermediate indicators of capital market depth and such like to a policy agenda, a time-determined policy agenda. That's what I heard you suggest. Is there something more you'd like to give as takeaways to the participants in today's conference?
No, except for the fact that I think all participants in today's conference should see themselves as ambassadors for these issues and very much go out and educate national policymakers to see what kind of public good we could be having if they do the right things.
That is a clear call to action for us all. Verena, would you like to share your closing thoughts?
So I think for me, it's a lot about that all these different areas of actions are ultimately linking together. So you need to be clear about how to push and also have concrete plans, which I think the Commission Action Plan is making a start at. And then for me, the other two things that are important is one, the European actors and the national actors need to push in the same direction. And we need to learn from each other and support each other in that movement. And I think Thomas's points there are very well taken. And finally, and coming back to my introductory remarks, ultimately we need to find a way to make this capital market union in Europe work for the investor and for the end investor. Because if we don't achieve that, we are not going to get there.
Indeed, it's not only about risk, but it's also about return and getting a higher return for the European inhabitant. Leonique, you're going to help us do this. So please, Leonique.
Well, I do agree that we're all ambassadors. And so we do feel very strong about that too, and being part of that conversation and to continue to contribute. Because we know that this is not all depending on legislation, the very lengthy debates. I do believe also that we also need to focus on further pan-European market practices and making sure what is best and share that. I do believe it's not only the European institutions that have to make it work. We need to work together with the private sector. We need to work together with the member states. There are quite a few participants in the market that have a very crucial role and can contribute to a capital markets union. So for me, it is very important to continue to publicize about this, to continue to talk about this, continue to involve parties that do have already some pretty good ideas on how to resolve some of those contentious points. So for me, it is a continuation of working together, publicize and measure accomplishments.
Thank you very much, Leonique. We'll continue to work together on this one. Ayla.
Yes, just one comment on this question, I believe, from PGGM about impact on near term and does it take decades? I think if we get to some kind of a plan and a direction of travel becomes clear and visible, we know that financial markets, they work live by anticipation. If you know that this is the way things are going to happen, then they start to act upon it already now. We have seen this in sustainable finance very clearly. So not necessarily, but it has to be clear where we are going and approximately at what page, and we can already pace and we can already have an impact today. The other thing which I think is just based on my experience from the sustainable finance work with the Commission and the European Union, the idea that they had to put together a group of people from all the possible stakeholders, public sector, private sector, third sector, buy side, sell side, people in the middle providing services, providing data, and actually having them to work on the solutions in very concrete terms, splitting it into different work streams. And I have to agree, I have to say that at the beginning, it was an overwhelming feeling, thinking we're never going to get there, but actually we have come such a long way in a couple of years, and it's astonishing. And I think there's a big difference in putting the people to work themselves and iron out their differences and finding the common denominators compared to consultations, because in consultations and feedback, it's very difficult to differentiate what is actual concern of something not functioning or what is just self-interest driven complaining. When you put people to work, they have to put aside their self-interest moaning and actually find the common ground. And I think Capital Markets Union is such a huge project, and as we have heard on this panel and all the previous ones, that there's hundreds of different sub-projects and KPIs there, that some of this work could probably work quite well with the same concept as the sustainable finance plan was handled with.
Thank you very much, Ayla. And then the last speaker, Fabrice.
Thank you very much.
To take the boat back in the harbor, huh? So wonderful.
Okay, you will recognize my thinking. But I think what comes out from this discussion is that clearly member states are key, because that's where the difficulties of conceding or contributing to something that is mutually benefiting to all needs to be clearly understood. And the ministers they were asking me a report, so they are very concrete. I remember one of them saying, why don't we have a Google in Europe? And he said, we have all the brains, we have all the IT technology available. Why don't we have it? Because we don't have this capital accelerator that allows it. So make it happen. Things like that. So it's very concrete, but I think they need to understand why they fight in this myriad of initiatives. They need to understand why they are discussing these very technical issues. And as you all said, it's a myriad. They need to understand it, not only understand it, but able to explain it when they are back home to their economic circles and to their citizens equally. So that's why I really see a lot of merits in creating these objectives, where you regroup by baskets a number of things, everything that concur to equity funding, everything that concur to long-term savings, create 3 or 4 intermediate objectives with KPIs, keep the momentum, keep them interested by the file. Because last time CMU1 was quite a disaster, because they were fighting, sorry, apologies, they were fighting on very technical files, and they lost the horizon and the vision and the why they were doing it. So keep them alert. They are interested by this, and they are the persons that will make the difference. Parliament is in favor of this. The report of the Parliament was extremely good. But member states, when it comes to defend their own interests, there you need to keep them interested in this, because it's mutually benefiting to them.
Thank you very much, Fabrice. Regroup, reorganize, prioritize, KPI. I've heard at least 10 or more concrete suggestions on KPIs. If only we have moved one of those further forwards, then it's been an extremely useful panel, and I'm sure we've done more than that in terms of inspiring others and each other on how we can make progress. The happy thing is I don't have to summarize this panel because we have a closing speaker. Can I thank all panelists very warmly for your contributions, and please can we now give the floor to Olaf Slijpen, who will provide some closing comments and perhaps some views also on this panel. Olaf, can we invite you to open your camera and your microphone? Olaf is Deputy Governor of the Dutch Central Bank. He is responsible for the central banking departments of DNB, and he's followed the whole conference from the beginning to the end. And so I'd really be thrilled to listen to Olaf's views, closing remarks on today's conference. Thank you to OMFIF. Thank you to the panelists, and thank you to Olaf for taking over the baton for the last leg of today's conference. Olaf, the virtual floor is yours.
Thank you very much, Art, and thank you to all participants for this very rich seminar. Indeed, it's my pleasure to close this conference today, but given the fact that we are talking about closing remarks, I also had to be very, very sharp the whole morning to follow all your interventions. Before I try to summarize the seminar, let me first of all thank a couple of people, of course, OMFIF and my colleagues from the Dutch Central Bank for organizing this seminar. In particular, I would like to thank David March and Art Hoeben for chairing the seminar and the panels. I think they did that in an excellent manner. Also would like to thank, of course, the lead speakers, Klaas, Philipp Hildebrand, and also the panelists that we had in both in the first panel and in the second panel. And last but not least, all the participants. I was not able to see all the questions in the chat, but I think all of you have participated very actively in asking questions. So making this, let's say, also an interactive seminar. Now, when we talk about Capital Markets Union, it's all about hurdles, it's all about obstacles, and I totally get it that I'm also, let's say, the hurdle or the obstacle between the seminar and maybe your lunch or another appointment. There's one thing I would really like to distance myself. That's a comment made by David about Dutch lunches, that it's only like ham and cheese sandwiches with buttermilk. Next time that we will organize this conference physically in Amsterdam, we will show you that there's much more about the Dutch lunch than buttermilk and the ham and cheese sandwiches. Anyway, I think let's go to the substance. First of all, I think we discussed the why of Capital Markets Union, and then we discussed the how. I think on the why, and I'm not very surprised about that, there is a clear view that why is there's no doubt about that. We need a Capital Markets Union, and I can go on and go on what the advantages of a capital market union are, but let me mention a few. It increases private risk sharing. It lowers financing costs. Apparently, there's still a uneven level playing field in this respect. It broadens the access to capital for small and medium enterprises, for startups. It broadens the financing base, so we would move from a more bank-based to a more markets-based financial system. It helps supporting the recovery post-COVID. It helps the monetary policy transmission process. It might even add to the international role of the euro in the international monetary system, and it helps private saving and therefore also fosters national pension systems. Now, let's then go to the how, and that I think in a way maybe is a more challenging question. Not that there's much disagreement about what needs to be done, but in particular, how do we get things, let's say, more the agenda, so that it doesn't come at the end of all the things that we need to do in the context, in particular, of the COVID crisis. Now, I think everybody agrees basically with the contents of the European Commission Capital Markets Union Action Plan. There's no disagreement there, which you can summarize, as was nicely done in the first panel, by information, regulation, and insolvency. However, I think it's also clear that we need more than that. And before going there, I think a very important, let's say, common denominator of the discussion this morning is that, in a way, Capital Markets Union acts as cement. I know it's maybe not be the best example. Cement apparently is not the most sustainable product, but it kind of ties a lot of objectives of the European Union together, and it does not only tie them together, it also reinforces them. To give you a number of examples, and they all came up in the session this morning. there's a strong link between capital markets union and banking union, and capital market union helps banking union, but also the other way around. The sustainability agenda of the European Commission was mentioned a few times. Digitalization and the digitalization agenda was mentioned a few times. Of course, the European Recovery Fund and the recovery itself, and I already mentioned it, also the monetary policy transmission process. So how to bring it further, how to bring it from a list, maybe a technocratic list of measures, to something that comes high on the political agenda. And there, I think, and this clearly, I think, also came out of the last panel, we need to change the narrative. That's how it starts. We need to link all those specific measures with, let's say, all those more strategic objectives that we would like to achieve in the European Union, thereby also creating a long-term commitment of politicians and policymakers, which is extremely important to markets. It's one of the key elements also mentioned in the speech and the contribution by Philipp Hildebrand. On top of that, we need clear objectives. We need KPIs, and Art was so good to challenge all of you to come up with already examples of KPIs that could be used. And indeed, then we are not talking about when a specific regulation should be implemented, but we are really talking about substance here. Of course, and that was also mentioned by a few of you, either directly or indirectly, there are also certain risks to such an approach. If it becomes too political, if we move too much towards grand schemes, there's also a risk that things will fail. So at the same time, it's also important to remain focused, to realize that fully realizing a capital markets union takes time, and also take the time to realize it, in particular for those proposals that, let's say, are contentious. Yeah, so these are also things that we need to take into account in the way forward. Now then, to finalize, what are, let's say, the next steps, and also the next steps when it comes to this conference? First of all, I think I sincerely hope that the next conference on Capital Markets Union organized by OMFIF and the Dutch Central Bank can be a physical seminar again. And not only for what I mentioned in the beginning, the misconception about the Dutch lunch, but also, let's say, to really meet physically again. Secondly, maybe it would be a good idea at this seminar indeed to take stock of where we are in terms of progress with respect to the Capital Markets Union, and also maybe already measure our progress a little bit towards those KPIs that were developed during this meeting, and we might add other ones. Also in the context of the proposals made by the Commission, there might be KPIs, and see where we are. And then, of course, finally, to see, okay, what still needs to be done, and what can our contribution be to achieving a capital markets union. There I would like to finish my closing remarks. Again, thank you very much on behalf of the Nederlandsche Bank, but also on behalf of OMFIF, if I may, for your active participation. And before you all going to leave this virtual seminar, I would like to give the floor to David Marsh. David, the floor is yours.
Yes, thanks very much, Olaf. And you've summed up the spirit perfectly, I think, and also put the emphasis on things that we actually do need to do now after having spoken about this. I'd just like to say three very brief points, along with, of course, the thanks to all the panelists, all the people who put so much work into this, to Klaas, who started us off so well, for Philipp for giving us the second keynote, and the moderator, the other moderator, my friend Art, who did very well indeed, and all the panelists. But the Dutch have got a great pioneering spirit, I think, They gave us Maastricht, which is the place where you come from, Olaf. And then 30 years later, they will give us Frank Elderson, now going to the ECB as one of the board members, the first Dutch board member there since Wim Dijsselbloem. And I do believe that the Dutch spirit of getting things done, building bridges, building dams, building dikes, seafaring nation, I think that's an extremely good metaphor for the way that we can go forward together. This is a remarkable project. If it was wartime, then we'd say it's like the Manhattan Project. It is not wartime, thank goodness, but we do need a lot of joined up thinking here. These scorecards, KPIs, call them what you will. I do hope that by the time we meet next time, we will not only have a vaccine, we will also have a KPI. And I do believe that we'll have a whole string of KPIs that we can measure, record, we can tell people off if they're not doing well enough. I do think it needs an independent body to help in these matters. I thought that Eli spoke very well about how we can't just give in to self-interested moaning. We do need to have people coming together in workshops in a common spirit, and that's the way we can get things moving. So I'd like to conclude now. Thank you everybody for listening. Look forward to the next time we do meet physically. I believe that we can say of the Dutch, they always surprise on the upside. So we can look forward to bread and cheese, but we may hope for wine and sumptuous feast at the Nederlandsche Bank. But more important than that, we really want to get this show on the road. We really want to serve up more than an hors d'oeuvre. We want now the Capital Markets Union to become the plat principal of Europe. I look forward to working with you all in that endeavor. Thank you very much for listening. This is David Marsh on behalf of the Nederlandsche Bank and the OMFIF saying goodbye to you and look forward to the next time when we can be speaking to you. Goodbye.